together with it. Okay. So if you are learning the management accounting, you should not only focus on the calculation, you should also understand the theoretical issues. So I want to say it again, the theory will take like 20 something marks or 30 something marks on a normal day, and the calculation will be like 70 or 60 something marks. So you cannot pass the paper relying on only the calculation aspect of the paper. Okay, so we are going to be looking at budgeting and the standard costing and variance analysis. So we are going to try our best to cover certain issues under this one. Okay, so the budgeting, what are we going to be looking at under the budgeting? Okay, so under the budgeting, we are going to be looking at, this is a new syllabus, so don't say that cash budget came last sitting, so it will not come again. This is a new syllabus, or this. So we'll be looking at cash budget. We'll be looking at cash budget. Then we look at the flexible budget. Okay, flexible budget, and we try our hand on functional budget. Okay, so functional budget. So cash budget, flexible budget, and functional budget. Then if you come to, I don't have question on master budget. Okay, they can give you master budget where they will ask you to prepare statement of profit or loss or statement of financial position. Okay, I don't have that question inside here. So we come to the standard costing and variance analysis. So we look at computation of basic variances. So the computation of basic variances and reconciliation statements. Okay, so if we are doing the reconciliation statements, we will be calculating the basic variance at the same time, so that will not be a problem here. Then we look at how to calculate material variances, taking into consideration the mix and the yield. Okay, then we also look at how to calculate capacity ratios. So we're looking at how to calculate efficiency ratio, okay, and its interpretation. So we'll be looking at capacity ratio, efficiency ratio, so capacity ratio, and production ratios. Okay, and we try to see if we can do what we call the working back approach. So they will give you the variances and they will ask you to calculate certain items that have been used to determine the variance. So at least we are going to be doing something. And so let me just see work back approach. Okay, work back approach. Then we also be looking at what we call the planning and operational variances. So planning and operational variances. The planning and operational variances is just the basic variances, but we are going to be separating the basic variances to the variance or the issue that has been caused. What is the difference in the variance at the planning level? So the time that management has planned this and given it to the tactical managers to now communicate it to the operational managers. What is the difference over there? So it's just the basic variance, but we separate it to the variance that has been created at the management level and the variance that has been created at the operational level. So that is what we call the planning and operational variances. So we are going to be picking one question on the issue about this one. So let's move on with, okay, let's move on with the first question. So who is reading for us? Yeah. Unfortunately, I don't have any of the readers over here. So someone should help us with the reading.
RF Limited.
Question number 1.
Charles, are you there?
Yes, sir.
Which name are you using?
I'm Charles William.
Sorry, I didn't check. I didn't check. But let's look at the requirement first. I thought you are not there. So sorry, take your position.
Okay, so the requirement is to prepare cash budgets for each of the first 3 months and in total.
Okay. So you should prepare for the first 3 months, isn't it?
Yes, sir.
Okay. So let's go and put the format there and see what we can do. Okay. So they say the first 3 months. So you just go and do your issue. Are they saying you should show the total too? Okay.
Yes, sir.
So we do it. So let's have our RF Limited. RF Limited. Cash budget. Cash budget for the first 3 months. For the first 3 months. We don't know whether it is of the year or whatever is the issue. So we come here and we have the month over here. So let's have the month. We have the 1, the 2. Okay. The first 3 months, isn't it? So you have the 1,
Yes, sir.
the 2, and we have our total here. So let's have our currency sign here, our currency sign here, and our currency sign here. So you'll be having your cash sales. So sometimes you can do the calculation and put all of them together. But what is going to happen is that you are going to be receiving cash. So you'll be having cash receipts. Okay, some of the sales, if you make it, you receive cash on the spot, and some of them it will be received in the following month. So we call that one receivables. Okay, receivables. So you can, let me just write it, receipt over here. Receipt should be the first one. So you just like you're preparing cash book. So you have your cash receipt and you take your payment. So this is just like preparing cash book in a vertical format. So you have the receipt, then we'll be looking at expenditure or payment over here. Anyhow, you want to, so let me just put expenditure here. Then the expenditure you don't know. So you go to the question and you can go and pick those ones now. So let's now, so let me send this one forward. Most of the time the receipt is not uh plenty as what as the, so let's come to the receipt. I'm sure the three can be there. So we do our workings over here. So we do our workings over here. Okay, Charles, you cannot take the question for us.
Okay, so question number 1. RF Limited is a new company which plans to manufacture a specialist electrical component. The company founders will invest 16,250 Ghana cedis on the first day of operations, that is, month 1. They will also transfer fixed capital assets to the company. The following information is available. The sales. The forecast sales for the first 4 months are as follows. So we have month 1 to 4 with the number of components they plan to sell. Then the selling price has been set at 10 cedis per component in the first 4 months.
Okay, so let's come here. Just after seeing that one, after seeing this one now, what do you have to do? What do you have to do? The first thing that you have to do over here is what? The sales forecast for the first 3 months, they have given you the unit that they are going to be selling, and they have given you the selling price. What do you have to do?
So you actually have
You
to
multiply.
So you determine your sales for each
Sales
month,
by-
not
Yes, sir.
multiply. You determine the sales for what? Each month. So you determine the sales for each month. So they can give you a cash budget that you have to prepare. You have to go ahead with a functional budget before you can prepare the cash budget. So you count to the sales. The first working will be the sales. So someone can name me the sales budget. There is no problem with that. So we have the sales budget over here. Then we do it for all the 4 months, although they are asking you for what? For only the first 3 months. But it can happen that some of the what? Some of the issues of the fourth month will be what? Will be affecting some of the calculation that we are going to be doing. So do it for all the 4 months, even if you are not asked to do the budget for the fourth month. So we count to month 2 here, we count to 3, and we count to 4. So you bring your currency sign here. You bring your currency sign here. You bring your currency sign here. Let's count to the components. So what is the demand? Demand in units. What is the demand for the first month?
1,500.
1,500. The second month is what?
1,750.
1,750. The third month?
2,000 and 2,100.
2,000 and 2,100, isn't it? Okay.
Yes, sir.
Our selling price per unit is what? Per component rather is what?
It's 10 series.
Okay, so you have 10 here, 10 here, 10 here, 10 here. So what will be your sales for each month? This will be 15,000. Am I correct? This will be 17,500. Is that okay? 20,000. And I'm having 21,000. Is that cool?
Yes, sir.
Okay. So this one, you are not going to be receiving the what? The money in full whenever the sales are being made. So you have to wait and see how how this particular amount will be will be received. Okay. So just let's move on now.
Sales receipts. We have time of payment and then the percentage of customers. In the month of sale, we have 20% of the customers.
So
1
after
month
seeing
later,
that, no, you don't worry. After seeing the 20%, what do? You know that you are going to be receiving what? Cash in the month of sale. So in the first month, in the month of sale, that is the month 1, we are going to be receiving 20% of what?
20% of that month's sale.
Okay, so that will be the cash. So let's find the 20% of all of them now. So the 20%, you can actually come here and do 20% of that month. You don't have to actually show working for that one. So 20% of 15,000, what are we having?
3,000.
Okay, 3,000. The second month, 20% of the second month, what are we having?
3,500.
3,000.
500.
Okay, so we have 3,500.
4,000 for the third month.
4,000. Okay, total is what?
Total 10,500.
10,000. All right, so let's go to how the remaining amount will be received. So let's come to
So 1 month later, 45% of the customers.
okay. So 45% of what? Please, what you do is you see sometimes they will give you the 20%, and the question will give you how the remaining 80% will be received. The remaining 80%, what we mean by the remaining 80% is that if you have taken 20%, then the 80%, which is the credit sales, the 80% will now be shared into what? Into 100 equal parts. So they'll now give you a percentage that will be equal to 100. So you have to just add it. If you add these percentages, what are we having?
95.
95. So there will be something like maybe bad debt or something like that over there. Oh, Charles, there's something over there. That should not go there. The 3,000, those ones should not go. Okay. So there's issue of discount over there. So we have to actually take the discount into consideration. So We haven't taken into consideration that particular discounts. Okay, so this is 95%. That will be a bad debt of 5%. This means that the sales that you are making for each year, that is how they are going to be doing like this. So 20% in the month of sale, 45% in the month after sale, and 25% 2 months later, and 5% 3 months later. What I'm trying to tell you is that sometimes the question will tell you like this. They will say 20% on the spot. Then they will say the remaining credit sales. So they will say the credit sales will be received like this. Then they will give you 60%. They will give you 30%. And they will now give you something like 10% in the following months. Okay. So you can see that it is not the full amount that we are receiving in this proportion, because this will give us 120. The full amount is 100%. So if you are giving something like this, it means that the 20% will be received on the spot. Then the remaining 80% will be received in this order. The remaining 80% will be received in this order. They can give you something like this, but they can also give you 20% in the month of sale. Then they can give you something like 25%. They'll give something like 50%, and they will give you something like what? 5%. This gives you a total of 100%. This means that it is the full amount of money that we are spreading into 100%, and we are receiving it like this. But if you are giving a percentage, if you total it, it is what? It is more than 100. What it means is that the remaining balance is what they are receiving in the order. Is the credit sales that will be received in this order. So the 20% is going, and we are receiving the 80% in this order now. But what is given to us over here is the full amount that we are receiving, because if you add them, we are going to be getting 95, bad debt of 5%. Okay, so let's move on to just count that down. The balance over there is bad debt. Okay.
So the balance represents anticipated bad debt.
Okay, so the 5% over there is the bad debt, isn't it?
Yes, sir.
Okay.
And they said a 2% discount is given to customers for payments received in the month of sale.
A 2% discount is given to the customers in the month in the month of sale. If you are paying in the month of sale, we are giving what? 2% to you. How do we calculate the amount that you are going to be receiving from these customers?
Hello, sir.
Yes, please.
My name is Henry. I'm looking at the 2% discount. What I think I did was I first computed the 20% and less 2% out of the 20%. Then I got 18%. On the cash receipt, I computed the 18% as my cash receipts for the month, for the first month of sales.
What did you get?
Wait, my book is not here. So I'm using my phone, so I'm struggling right now. But I think I computed 18%.
On the 3,000, isn't it?
Yes, sir. Yes, sir.
It will give you 2,940.
Okay,
Yeah.
2,940, isn't it?
Yeah.
Yeah, if you are getting 2,940, that is the right answer. Please, the discount will be given on the what? On the amount that they are receiving. If you are not paying in the month of sale, please, you are not going to be receiving a discount. So the discount will be given to the 20% of the amount that they are receiving. And the 20% over here, don't say that you are receiving 20%. So you come and take 2% and say you are having 80% on the 15,000. No, the discount is not given on the full amount. If you are giving the discount on the full amount, it means that whether you pay or not, the discount given over here is a cash discount, not a trade discount. Okay, it's a cash discount. If you pay early, you receive. So those are going to be paying. They are going to be the one to receive it. But if it should be a trade discount, that one, whether you are paying early or not, you are going to be enjoying it. This is a cash discount. So what you do over here is, okay, that's what our brother has said. So what you do over here is that you first of all find your 20%. So what I will do is this one. For me, this is what I will do. I will do 20% on the 15,000. Okay, then I'll do 0.98. Okay, so we are going to be giving the 3,000 over here. We are going to be giving 2% to the people as discount. So what I will do is that we are going to be receiving only, so this one now becomes 100%. If you are receiving all this money now, it means that you are receiving 100% or the 20%. But we are giving a discount of 2%. So what it means is that I will be doing 98 what percent because I'm giving 2% of the 3,000 that I'm receiving, which is this one. Okay, so what you do over here is that you can actually calculate the 20% first. This is a cash discount. When you pay in the month, you receive it. So only 20% people will be receiving. How much are they paying and how much discount are we giving to them? So they are going to be receiving 0.2 multiplied by the 15,000. That is the amount that is supposed to pay. We are giving a discount of 2%. So you can calculate the discount on the 3,000. Then you now subtract it from the 3,000 that you are receiving. In other words, you are receiving only 98% of the 3,000. So let's do the discount somewhere because that is a, for me, I will not do it. What I'll do is I'll just do 0.2 in the bracket multiplied by the 0.98 at where the receipt is. But since this is going to be a major calculation, let's compute the discount over here. So we have the discount computation or the payment. Okay, payments, not payment, receipts. That will be receipts. So cash receipts. So let me just say the cash receipt over here. So the cash receipt we have month 1, month 2, month 3. Please, we are doing for only 3 months. So just determine the cash receipt for those months. This is what I will do. I will do 20% at 98%. Okay. So let's find 20% of the sales and the what? And the 98% of that. So 0.2 multiplied by 0.98. You can change this one to then 19.6% of the what? Of the cash that you are receiving. And that will give you the what? The figure there. What are we having? 29.
2940.
Okay.
That's 430.
First of all,
30. 343.
okay.
343.
And the last one is what?
3920.
3920.
Okay, 3920. Okay. So you have, so we just put workings 2 here. So 3940. Then we have 3430. We have 3920. What will now be the total?
One
11290.
11.
290.
10290. The first month is 2940, not 3.
Oh, sorry, 29. Because the first one that we did, we got to 10,500. So how come this one is now higher than that one? So it's supposed to be what?
10290.
Okay,
The
1029. Okay, 10290. Okay, so let's now compute the issue of the receipts now. So we're doing the receipts now. Okay, so just 1 month later, what are we receiving?
We're receiving 45%.
And then 2 months later, we are receiving what?
25%.
And 3 months later, we are receiving what?
That's 5%.
Okay, so 1 month later for the month 1 is which month?
That's month 2.
That's month 2. Okay, so what you do over here is you do your receipts over here. Okay, so that I'll be having my receipt over here as let me just say receivables. So 3 over here. Please, we are only focusing on only what? Only 3 months, isn't it? So you have your month here, which will be 1, 2, and 3. Okay, so let's come here. So we are
Yes, sir.
receiving 45% first. Okay. Then 25% followed, isn't it?
Yes, sir.
Yes, sir.
And we have what? 5%. The remaining one
Yes,
is
sir.
bad debt. Please, bad debt is a non-cash item. So you don't have to even include it because whatever we are doing over here is excluding bad debt. So the bad debt, if you are doing profit or loss, that's when you send a bad debt over there as your figure. So I can use this example to demonstrate the profit or loss for you. Okay. We are not going to be receiving any of these ones in month one, isn't it? Month one will be dash. So the month one is the starting month. Month one is the starting month. There is no other month before this month. So there's no going to be any 45, 25 received in month one. I hope that is okay. Okay.
Yes,
We
sir.
have dash, dash, dash. But we know that 45% of the total sales, 25% of the total sales in month, 45% of the total sales in month one will be received in what?
Month 2,
Month two. How much will be that?
6,750.
6750.
Okay,
6750.
6750. Okay. Then month two, 45% of month two will be received in month three, isn't it?
Yes, sir.
So just do that one. Do the 45 first, then you count the 25, then you do the 5% also. So 45% of
45.
month two will be received in month three, and that will give us 17,500 multiplied by that one. I'm having
75.
7,875. Okay. Let's now count to the what? The 25. None of the 25 will be received in what? In month two,
Month
isn't
1
it?
and 2.
Okay. None of this one because this one we are going to be receiving. This one 2 months. So that will be in the third month. So this will be dash. So how much are we receiving? 25 of that one. When are we?
3750.
3,000.
750.
750.
Okay. 3,750. Okay. Please, we are not doing month 4. If we are doing month 4, then the second month will be received in the fourth month. Okay. Would there be 5% received in any of these months?
No.
If the first month is January, we're supposed to receive the 3-month letter in April, isn't it?
Yes.
Okay, so this will be dash and dash over here. Okay, so we have dash over here. Then we have 6750 here. Then we now have the total over here to be what?
One 1,625.
11625. I hope we are okay with the schedule. If you have any issue, you can raise it now. We address it and move forward. Okay. We don't want a situation where we'll be moving and you'll not be taking us back. Okay. Yeah, Sinakafe.
Yeah, sir, I normally get confused with the cash budget. Is it done on accrual basis?
They are saying cash and you say accrual.
No, I mean, with the receivables, we are yet to receive, but it's being recorded.
No,
think we are
the receivable, they will give you how the receivable will be received. So we are only taking into consideration when they will be received. So 45% will be received in the month two. So we are receiving there was 6750 in cash in the second month. That's why we are including it in the second month.
It has been confusing, that's why I want to.
Okay. So I have 67. This will be dash 6750.
Sir,
Yes, please.
sir, please, about how you share the percentage on them. Can you please go over?
I cannot hear you, ma.
Your voice is low.
I'm talking about how the percentage you work on it, the 45 and then 25 from the first one to the third one. I'm getting confused. Can you go over for me?
How do you think it should be worked?
So I was thinking that maybe when you take the 45%, since the month one is not bad, maybe you work it on the
I cannot hear you, please.
3430 that we got.
I cannot hear you. I cannot hear you. If you can.
I said I was thinking like maybe when you take the 45%, you work it on
Why should it be maybe? If you are saying maybe, it means I don't have a point.
I'm a little confused right now.
Why should it be maybe? You are making a point, you are saying maybe. Okay, you should take ownership or possession of your point, not maybe. If you are taking maybe, then you are not sure of what you are saying. So why will it be maybe? Yes, be bold so that we can correct you, and the boldness will vanish. But if you are maybe you don't know what to do, maybe along the line, then that particular spirit will enter you again. So just say the boat we take that particular, we deliver you from that one, so that the spirit will not come again. So
Okay.
yeah, let's move on now.
I would say like maybe when you take the 45%.
You like maybe, Pao?
It's
Okay, let's move on. Maybe
I said when you take the 45%, I was thinking like we work it on the maybe the okay, I'm not using that maybe again. The
no, you don't worry,
3,000
don't worry. You can use it. I understand.
that we got, yeah.
Yeah.
But
So
when I
you are
like,
saying that
when
if we take the 20%, then
the 5%,
okay.
you work it on the amount that we got when you we work on the cash receipt.
So you are saying that we should work the 45 on 12,000, isn't it?
Yes.
Is that what you're saying?
Yes.
Work on it. Work the 45 on it. Let's see. So the first one we are receiving 3,000, and we are giving them a discount of 2%. So work the 45 on this one. Give us the figure.
Okay, so when I work on the 12,000, I got 5,400.
5,000. 5,000 what?
400.
Okay, 5,400. Okay, then you work the 25% on that one too, isn't it?
Then the 5,400 wasn't on the 3,000.
No, the 5,000, 45% on this one, isn't it?
Yeah, on the 12,000.
And you have gotten 5,400. How are you going to be working the 25%?
Okay.
The 25%, how do you work it?
Working it on the 5,400.
How?
So that is where the confusion comes in.
If you sell to people and you have received 5,400 from some of the people that you sold to on credit, the remaining amount that you are going to receive from people, is it going to be worked on the amount that you have received from people?
No, sir.
So why are you doing that? I was even thinking you are going to be working the 25% on the 12,000. Then I would say you should add the final figure that you have gotten and check whether it will be 15,000. You have sold 15,000 items to people. You have received 20% in the first month. Okay, and that 20% you have given 2% as discount. You are saying that 45% of that particular total amount. So you are spreading this amount into months. So you are selling to people on credit. So you are saying that okay, they will pay 20% in the first month, 45% in the second month, and 25% in the third month, and this one in the fourth month. Okay, the fourth month is just like the 3 months after the sale. Then 5% will be declared as bad debt after that particular one. So you will not be able to receive 5% of the total amount. So if you want to know 15,000, how much are you receiving in the first month? You'll be receiving 3,000, out of which you'll be giving discount to the people. The second month, you are going to be receiving 7,050. The third month, you are going to be receiving 3,750. And the fourth month, how much are you going to be receiving?
Yes, I'm coming.
in the fourth month, 0.5% of 15,000. I'm receiving 750, isn't it? If you add all of this, you'll be getting something like 14,250, which means that the bad debt is 750. Okay, so this is an amount that you are this is item that you are selling to people, and instead of them paying the 100% on the spot, you say you want to give them a payment term that you should pay 20% now, and you pay remaining, or you pay 45% in a month's time and 25% in a month's time. If you are coming to attend class with me and I'm charging 400 Ghana cedis and you are asking me for a payment term and I've asked you to pay 17% down, the next payment 30%, are you going to be calculating it on the 70% that you have paid?
No, sir.
Lanas.
Please.
Lanas.
Yes, please.
I think you want to work back, but maybe she was confused. Like making the 20%, that will give you 3,000. If you want to work the 45% to get the 6,750, you should have make it like 3,000 multiplied by 45/20. That will give you the 6,750. I think that's what they want to work, maybe, or something like that.
How will you think like that if the person is not getting this simple one?
Yeah.
Madam, is your confusion okay now?
Yes, I'm okay. Thank you.
Okay. Okay. So, Charles, I hope you are there.
Yes, sir.
Total is what? Total for
18375.
48.
Mm,
Sorry,
18375.
18375.
18375. So you'll be moving now to see whether there will
Yeah.
be another receipt from that particular one. Please, the bad debt, ignore the bad debt.
Okay, so the next information deals with production and then purchases.
Read it then, just.
Okay, so production. There will be no opening inventory of finished goods in month 1, but after that, it will be policy for the closing inventory to be equal to 20% of the following month's forecast sales.
There will not be what?
There will not be any opening inventory of finished goods in month 1.
Even if you are not told, Charles, even if you are not told, the only time that we do the opening stock is where sometimes they will give you, if this month should be given to you like December, okay, then they will bring January, December last year, and they will bring January. And the question is asking you for the cash budget from this particular period. Okay, it means that if you are using this particular policy to the finished goods, the closing stock in December was the what? Was the 20% of January figure, isn't it?
Yes, sir.
Yes.
Okay. And so in the next year now, that 20% of the January sales itself will become the opening stock. Okay, but this one you are giving months. It means that there was no other month before. So you cannot assume that 20% on the sales of 20% on the sales of the month 1 sales is the opening stock. No. There was no other month. So are you saying that there was month 0 and the month 1, 20% of the month 1 sales was a closing stock that particular period? No. So even if you are not told, you can only make that assumption when you have a previous month, when the question has given you information relating to the previous month. It means that the entity has been in operation not only this year. Okay, so the question will always give you that one so that you can assume that 20% of the month that you are starting from was the what? Was the closing stock, then it will become opening stock for the month itself. So they will give you a question that, but if they are asking us to start from month 2, then it means that the month 2's what 20% will be the closing stock for month 1. Therefore, it will become here as opening stock. But there's month 1, so it means that there was no month like 0. So even if you are not told, that is what you are going to be doing. All right. So let's come here. They are giving us information on what? On purchases or production. Okay. Let's come here. This is a cash budget or production budget involving a cash budget. So from this side, I don't think we have to do anything for the production budget again because we'll be doing it over here. Production, there will be no opening inventory of finished goods in month 1, but after that, it will be policy for the closing inventory to be what? Equal to 20% of the following month forecast what? Sales. This is production, isn't it? So we are going to be producing the component that we are selling. We are going to be producing the component that we are selling. Okay, so let's come to our production budget now. We have to know our production budget. Then we know the quantity that we are going to be selling. Okay, so we want to know this one that we know what we are going to be selling there. Okay, so we need to prepare the production budget. I want to tell you something here. Okay, there should be information there. Okay, I want to give you something here. They should give you an information here, but if information is not given, then I'll give you what that you have to do. Okay, so let's come here. So let's come to production budget now. So you have to produce your production budget before you can be able to know your cost for labor and those things. So we have the production. Okay, production budget, we now do month 1, month 2, and month 3. If you want to produce, okay, you have departments, you have sales department, you have production departments. Okay, what we have to know is that the production departments are not going to produce and okay, so whatever they are going to be doing, over there, they will do it on the demand of the sales department. So if you are going to be selling 1,500 and you don't want to keep any closing stock and opening stock, how many quantities are you going to be producing? You want to sell 5,000 units. If you don't want to keep any closing and opening stock, how many units or how many quantities are you going to be producing?
5,000.
No, we are selling 1,500.
1,500.
Okay, so we always start with what? With a sales budget. Okay, so I will do the units over here. So it is a sales department that are going to be telling the production department what they should produce. Okay, so we come to our sales here, or we look at the demand for the sales. The first year is what? 1,500, isn't it?
Yes, sir.
Then we have 1,750. Then we now have what? 2,000. Is that correct? Okay.
Yes, sir.
If there is no opening stock and no closing stock, it means that we have to produce all the 1,500, isn't it?
Yes, sir.
Okay. Now we want to produce a particular quantity and we give the sales department 1,500 and you still keep 20% at the production house. What is the 20% of what? Of the second month. They say the closing inventory will be for the following months. So 20% of the following month what? Forecast sales. So 20% of the following month forecast sales. So 20% of the following month. What is the forecast sales for the following month?
17,500.
So 20% of that is given as what?
350.
350. Okay. So you want to produce. Okay. You want to produce now. If you produce, you are going to be giving 1,500 to the sales department, and you are going to be keeping how much?
350.
You are going to be keeping 350, isn't it?
Yes, sir.
How many quantity do you have to produce?
1,550.
180.
So
1,850.
closing stock will always be an addition. So you add the 350 here. Okay. Assuming the entity is having 100 units at the beginning already, they are having 100 units in the what? At the production center, or they are having 100 units of finished goods. How many quantities do they have to produce? Assuming they have 100 units already. Assuming they have 100 units already, and the sales department is demanding for 1,500. How many units do they have to produce to be able to give the 1,500 to the sales department?
1,400.
1,400. Okay, so the opening stock will always be a deduction to what? To the sales over there. So I'll bring opening stock over here. There is no opening stock. So there's no opening stock. I'll put that here. But the opening stock for this one will be what? 350, isn't it?
Yes.
Okay. Then what will be the closing stock for the month 2?
400.
Okay, that will be 400, isn't it? And the opening stock over here will be 400. What will be the what? What will be the closing stock for that particular month? 0.2 multiplied by the 4th month. I'm having
420.
420. So let's now find our total production. Okay, how many quantity do you have to produce in total? The first month is what?
1850.
1850, isn't it?
Yes, sir.
Okay, so the second one is what? 1,900. Is that correct?
It's 1,800.
Is it 800?
Yes, sir.
Okay, okay.
Yes, it's 1,000.
1,800. Because 350 against 400 will be left with 50. Okay, the last one is what? 2020.
2020, yeah.
Okay, so we have 2020. Okay, this one, the focus is not about the functional budget. This one, the question can also give you the quantity that is being required to produce 1 unit. Then you have to prepare material usage budget, then to know the quantity that you are going to be buying. Okay, the question can go ahead to tell you that, okay, the entity uses 2 kilograms of this particular material to produce, and you want to produce 1,800, and each unit is requiring what? 2 kilograms of a particular material. So for you to know the total material that you have to purchase, you have to multiply by this. So you might be having some material in store and you have to do other issues. But this one, the focus is not about that one. The only focus over here is to do the production budget. Okay, let's come here. The
Said variable production cost. It's expected to be 6 cedis 40 pesos per component.
okay, and they have break that they are breaking down that particular one for us now, isn't it?
Yes, sir. So direct material is 1 cedi 90 pesos. And the notes for direct materials, they said 100% of the materials required for production will be purchased in the month of production. No inventory of materials will be held, and direct materials will be paid for in the month following purchase.
Okay, Charles, I'm coming in. Okay. So you see, the reason why we are not going to be multiplying the 6.4 by the component that we are producing. Okay. So they are saying that we are going to be buying the raw material. Okay, the raw material cost per the component is 1.9. You know how to get the raw material, the direct material cost per unit, isn't it? We multiply the quantity that we are using by the price per the quantity that we are using. That's how we do it to get this one. So it means that the quantity that you are using has already been factored over here. So now, if you are producing every unit that you are producing, the material cost that you are going to be incurring per component is 1.9. Okay, what is the quantity that we are producing here? If direct material cost, so you come here and do your direct material cost. Okay, so direct material cost, they have given you the cost per component already. So you have your amount over here, 1, 2, 3. Okay, so you have the demand over here, or the production. Okay, you can also say production unit over here, anyhow you want to do it. So we are producing 1,800 and 2020 in the 3rd month. So this is the quantity that we are producing. It is the production that is going to determine what? The material. So we buy the material based on the unit that we want to produce in each of the months. Then you count the rate now, the rate per component. the rate per component or unit. How much is it? 1.9.
1.9.
Okay, 1.9, 1.9, 1.9. What is the cost that we are going to be? What is the cost of the material that we are going to be purchasing every month?
First one is 3515.
3515. Okay.
Second one, 34 things.
34.
50. That's 40.
60.
3420.
3838.
20 for level 2.
Yeah.
Okay.
And then 3838.
3838. How are we paying this?
They said it's going to be paid in the month following the purchase.
The month following the what?
Following the purchase.
No. Direct material. 100% of direct material required for production will be purchased in the month of production. Will be purchased in the month of production. Okay, no inventory of raw material will be held. So direct materials will be paid for in the month following the what? The purchase. Okay, so we are going to be buying in the month of production, but the buying will be on credit, isn't it?
Yes, sir.
So
Yes.
So it means that the first month we are not going to be paying any amount for the direct material. So I'll count to direct material cost over here. Direct material. This will be dashed for the first month, isn't it?
Yes, sir.
This month will be what?
3515.
3515.
And 3420.
So we have 3515, 3420. The total will give us what?
6935.
6935.
6935.
35.
Okay. So the material will be purchased in the month of production, but it will be paid in the month following. So we are going to be buying, but the supply will be on credit. Okay. So, but this one, they can also give you how this will be paid. They can give it to you how it will be paid. They can say 60% will be paid in the month of what? Purchase, 40% in the month following the what? Or in the month after the what? After the purchase. How do we go about it? How do we go about that one? 60% in the month of purchase and 40% in the month following what? Following or in the month after the
So,
purchase. How do we go about it?
so the first month we had material cost of 3515. If we are to pay 60% of that, we'll pay 2109 in that first month one. Then the balance is going to be settled in the next month.
Okay. No problem. Okay, no problem. Okay. Let's calculate the direct wages now and know how it will be paid. Okay. So this amount will always be, so you have your direct wages. So direct wages will be based on the production. All these costs are going to be incurred on the production. So they are determined on the production, not the sales. You are going to be engaging the people in the production. The material will be used to produce. So the quantity that you want to produce will determine the quantity that you have to buy. So let's count to this one. This will also be based on the month 1, 2, and 3. So I have the production of 1850, 1800, and 2020. What is the rate? The rate of the
3.3.
3.3.
Okay, 3.3, 3.3, 3.3. What are we having as the cost for each of
The
them?
first one is 6105.
6105. Okay.
5940.
5940. And the last one is what?
6666.
6666.
6,
Mark
6.
on time, please.
6.
4 6s.
Okay, 6, 6, 6, 6. Okay. Let's come to how we are going to be paying these amounts now.
They
How
said
are we?
it will be paid for in the month in which the production occurs.
So it means that all of them will be paid in their respective months, isn't it?
Yes, sir.
Okay. So these people, they are not what? They are not government workers in Ghana, or they are not employees in Ghana, where they will be waiting to receive their salary in the following month. No, they want to receive it in the month. If not, a lot of things will happen. So 6-1. So we have direct wages over here. Direct wages over here to be 6105. Then we have 60
5940.
5940. Okay. 5940. Then we have
4
666.
6s.
Okay. Then what is the total?
18711.
18.
711.
1.
I'm having 18756.
Okay. So let's confirm that.
18711.
18711. So 1850 plus 1800 plus 2020 multiplied by 3.3. 18711.
Yes, yes.
Okay. So 18711. Okay. Let's go to the variable overhead cost now. So we have the variable overhead cost. Please, if you like, you can actually put all of these costs together and mention it what? The variable cost. So you can do the workings one by one and call it variable cost. But what will happen is that don't take this one. Okay. Don't take the variable cost and multiply the 6.4 and just multiply by the respective quantities that you are going to be producing, and bring it to the month. So you can see that some of the costs are not going to be settled in the month of purchases. So what you do is you calculate their own individually, but you now come and do the schedule for them. That is going to be taking your time. So you just take them one by one and deal with them. The variable cost per component is what?
1.2.
1.2.
So we have the month over here. It is also going to be based on the production. So 1, 2, 3. So we have our production in terms of units over here. Production, that will be 1850, 1800, and 2020. Okay. So the rate per component is what? 1.2, isn't it? 1.2.
Yes, sir.
So what are we getting?
2220.
22.
2220.
Okay.
2160.
21.
60.
Okay.
And 2424.
24.
24.
Okay. So let's look at this is their respective cost that we are going to be incurring. But let's see how this cost will be settled. Let's check how.
They said 60% will be paid in the month in which production occurs, and the remainder will be paid 1 month later.
So it means that 60% of all these amounts will be paid in what? In their
That same
respective
month.
months. So let's come to the 60% and 40%. So 60% is what?
1332.
1332.
32.
Okay. 40% of that will be received in what? Month 2.
Yes, sir.
And that will give us how much?
888.
888.
Okay, so we have 888. This one dash will come here, isn't it? Okay. There will not be any 40% in month 1. Okay, let's come to the second month. 60% of that. What are we getting?
1296.
1296.
1296.
96.
96. And each 40% will be in month 3, isn't it?
864.
Yes, sir.
86,
4.
864. What are the 60% in the 3rd month?
1454.4.
Okay, 1454.4. So let's now total all of them together and go and send them there.
They say to leave it to the nearest one Ghana cedis.
So
they
that will be
convert it.
1454, isn't it?
Yes.
Okay, 1454. So let's put them together. Month 1 will be 1332,
2184.
2184,
2318.
2318. Okay. So we have 13. So we have direct what? Or we have variable overhead, isn't it?
Yes, sir.
Variable overhead is
I see.
1332. Just mention the figures for me.
2184.
2184
84. And 2318.
2318. Total is what?
Five eight three four.
5834.
58. I'm having
34.
35. Is it 35 or 34?
Hey, 34.
It's
Yes,
34. Okay. 5834. Okay. It means I don't think there's any other figure. So I have to shift this one to the top one. But let's be moving because I don't have space to show the opening and then the closing balances there. Let's come to fixed overheads.
So fixed overhead costs. They are estimated at 75,000 cedis per annum and are expected to be incurred in equal amounts each month. 60% of the fixed overhead costs will be paid in the month in which they are incurred and 30% in the following month. The balance represents depreciation of fixed assets.
Okay. So the 75,000 there is per annum, isn't it?
Yes, sir.
Yes.
And we are doing this for every month, isn't it?
Yes, sir.
Yes, sir.
So what do we have to do first?
Divide by
Yep,
12.
divide it.
Okay, so we find the monthly fixed cost, isn't it?
Yes,
So
sir.
you find the monthly fixed cost. Monthly fixed cost. That will give us 75,000 divided by
Divide
12.
by 2.
What are we having?
6250.
6250.
6250. Okay. Then we now look at how these fixed costs will be paid now. So we have our fixed cost now. Okay. So we are seeing a 60% in the month of production and what?
30% in the month following that.
Okay. So let's count to 60%. So the remaining 10% is depreciation, isn't it?
Yes, sir.
Yes,
So
sir.
if you are doing profit or loss, you send the total fixed cost there. You send the remaining one as what? As depreciation. Okay. So let's come to this one. 60% of 6250. What are we getting?
3750.
3750.
3750. Okay. Then this one will be 3750, isn't it?
Yes, sir.
Yes, sir.
Each of them will be 3750. There will not be any 30% in this month, isn't it?
Yes, sir.
So the remaining 30% will be give us what?
1875.
1875. So we have 1875 here, 1875 here. Please, you have to take note of this. Okay. It's a fixed cost that they are sharing like this. 60% will be paid, 30% will be paid, and 10% will be a depreciation. So if you want to know the 90%, okay, if you want to know the one after depreciation, any amount that you are going to be getting, which will be 0.9 multiplied by the 6250, which is 5625. This will be after depreciation. So this is 90% of this. So if you want to share, it should be 60 over 90 multiplied by 5625, because this amount that you are sharing is not 100%. We only do 10%. This 10% is over 100. It means that what we are sharing is a full amount. That is a full 100%. That's what we are sharing. So don't say you are coming to do 60% of this remaining amount. 60% means 60 over 100. The figure that you have over here is 90%. So it's supposed to be 60 over 90. Okay. I'm sure we'll be getting 5625 for the remaining two months, isn't it?
Yes.
Yes, sir.
So we are having the 3750, and we'll be having 5625. 2625. Okay. So let's count to I have to bring this one to the top some more. Let's find the total receipt first. So let's total this one before I will send that one to the top. This will be 2940. This one will be what?
So the total at the last part is 28665.
28.
665.
The month two is what?
10180.
180. Okay.
10180.
And 15545.
15545.
545.
Okay. So I'll bring the expenditure now. We'll be bringing it one by one to the top there. So we have material costs. So material cost, the first one will be dash, isn't it? So we have 31153420, and that will give us 6935. So I'll take this one off now. So we have labor cost to be, 6105, 5940, and 6666. Total is 18711, isn't it?
Yes, sir.
Yes.
Okay. Then we come to our variable overhead. So we have our variable overhead there. Variable overhead to be 1332, 2184, 2318, and we have 5834, isn't it?
Yes, sir.
Okay. So we now have the fixed cost, isn't it?
Yeah. Yes, sir.
So the fixed cost will give us what?
3750.
3750,
5625.
5625,
And 5625.
5625. What are we having?
15,000.
15,000.
Okay. So we have 15,000. Let's find the total now. So we name this one to be A. Then we name the total over here to be B and subtract.
A is 2.
The month one is what?
One is 11187.
111.
87.
Okay. So we have 11187.
The total is 46480.
46.
480.
Okay.
16464.
Month two.
16464.
16464. Okay.
1312029.
120.
I'm having 18029.
Yeah, someone should confirm. 180 or 120.
I'm having 180.
18029 for the month, right?
Okay. So what would be the net? What would be the net cash flow for the year? Net cash flow. The net cash
We-
flow will be A minus B. What are we having? The receipts against the payments.
Having a negative balance of 17815
Uh,
for the
so let's
total.
check the month 2.
Yes, I got 17264.2.
One
Yes, 17264 for the month 2.
172.
64.
Okay, 17264. Okay, I hope apart from that one, everything is correct, isn't it?
Yes, sir.
Okay, what would be the difference there?
In month 2, I'm having 7084
Negative.
adverse.
Okay,
7084
7084. If
adverse.
you come to this one,
I'm having 2484 adverse.
are you sure?
Yes, sir.
No. Okay, this is also adverse. Okay, 155 against this one, so that will be adverse. Okay, so I'll have
484.
2483. We are going to 3. Is it 84 or 83?
Say 84.
84.
Okay, so 84. So let's come here. This is just a cash flow. What do we do? If you are doing cash flow statement, after getting the net cash flow from all the activities, what do you do? This figure will be added to what? To the balance at the start of every of this period, isn't it? This is just the movement from the cash that we have received and the cash that we have spent for the year or for each of the months. But we have some cash before. So this is the cash that we have received from each of the months. These are the expenses. So we haven't touched our what? Our cash that we have at the beginning. This is just the cash movement during the year. So at the end of the day, you will now bring your what? Your cash balance there. So let's see whether we have a cash balance there. In the question, I'm sure at the top there, you can see something like that over there. Okay.
The
It's-
company will
It
invest.
said the company founders will invest 16,250 on the first day of operations.
So that will be there at the beginning of the first month, isn't it?
Yes, they said that
So-
is month 1.
So that will be what? That will be the opening balance. So let's adjust. So what will be? So we now have opening balance and have closing balance. I don't have space here. Okay, let me do the opening balance and then the closing balance here. So continuation of the cash forecast. So please just pay attention to this one so we have month 1 and this one. What is our opening balance? Balance brought down
16250.
250. Okay, what will be the net figure now? You can see that the net spending for the net for the year is what? Is a loss. So it means that we received 2940 and we have spent this one. It means that we have touched some of our cash that we have at the beginning. So how much will be left now?
8003.
800.
3.
Right.
So that will be the closing balance. 8003. So you can do balance carry down over here. This will become what? Opening balance for the
Opening
month
balance.
2, isn't it?
Yes, sir.
Okay. What are you going to be having? The difference over there. What will be the balance that will be left?
919.
91.
9.
9.
Are you sure? 919.
Yes, sir.
Okay.
Yes, sir.
So that will be left with 919. Okay. 919 will become what?
Opening balance.
Balance brought.
Okay. What is the spending over here?
Spending is
For
2484.
What will be the difference?
1565.
1565.
Negative.
1565.
Okay. Negative 15. Negative. So that will be 1565.
65.
Okay. The question now is how do we do the what? How do we go about the closing figure now? What is the difference that you are getting? as a balance for
Put together.
the closing there. What will be the net cash flow on total basis?
1715.
On the total basis,
17815.
178. Okay. 17815, isn't it?
Yes, sir.
Okay. So the total, that one is negative, isn't it?
Yes, sir.
So we have 178. 178 what?
That
One
that
five.
one will not be
178.
17815.
Okay. 15. Okay. Yes. So the closing, how do you go about it? Okay. This will be, no, this will not be here. This is supposed to be at the end part there. Okay. So this is supposed not to be here. We assume that the closing is computed at that particular area there now. So how do we go about, let me bring this one. This will give us 17815.
15.
Okay.
so
So
you bring the cash at the beginning to that place to not
how do we treat this one now? Just the year 4.
Thank you.
Do we
So
send the
yeah, first
1565 there, or what do we put there?
the total. It will be you bring the 16250 there.
Just do you agree?
so I don't even know what he said, please.
He said we should bring the 16250 there.
No idea, sir.
So what do you think we should send there?
Is it year 4?
No, that is
It's not
total.
year
We
4,
don't
it's
have month
total.
4. That is total.
I think we will add all the balance brought down, then we send it there, then we subtract and get it carried down.
You add all the balance brought down.
Also,
No place.
But we will add the net cash flow
No place.
and send it.
No place. Please look at this one. The total. Okay. The total over here. You can see that everything that is happening at the end of every year that has been factored into this place. You can see the total is the what? Is this one. The total over here are these figures. And the total is also this one. So the net effect in each month has been what? Has been grossed up to get this particular one. So this 17815 over here is the total net spending for the 3 months. That is before taking into consideration what? The opening balance. So the total net spending, if you come here, 1, 2, 3, 4, 1, 2, 3, put together is the 17815. So before we touch our what? Before we even rely on our opening balance, how much has been spent? What is our net spending for the what? For the first 3 months. This is the total over here. So what you do is that the total over here is before taking into consideration the opening balance. So you just bring the 16250 over here, and your difference will always be the same as the one that you have at the what? At the closing. The difference between the two will always be the one at the closing. Okay. The total is just the net, is just the sum of or the aggregate of all that happened during the what? During the month of operation. So the total over there are the figures before the opening balance. So if for the 3 months in total we are spending, we have a net spending of 17815. That's the total net spending. And we have 16250 at the beginning. What would be the effect, or what would be the net spending after going or after using our opening balance? So that is it. You just bring the opening balance here. This is total. This is not the following one. This is total. The total is the net result. Putting everything together, the net result. You just take the 162, you'll be getting the same answer over here as the net. Very simple. So the balance at the 3rd year or in the last month or the last quarter to the total should be the same as the balance that you're having in total. The balance that you're having over here at the end of the 3 months, which will go to what? The 4th month is 1565. So your total should, if you are comparing your total receipts This will be the total receipt. The total receipt is this figure, isn't it?
Yes, sir.
Okay. And before this one, we have 16250, isn't it?
Yes, sir.
So what
For
will be
that.
our total receipt for the 3 months? If we are adding the opening balance, what will be our total receipt?
44915.
Against our total expenditure now. Total expenditure is 464850. 480.
So
What are you having?
a negative 1565.
That is it. So the total, sir, you have to be very careful. The total, the effect of every of these months has been factored into the total already. So that is the summation of the total. So the only thing that you take away from that one is either you add the opening balance at the beginning of the operation or you subtract, depending on what you have over there. They can have bank overdraft or they can have any other issue there. So that will be, you have a net spending of 1565. Okay, a very simple exercise there. Okay. Just let's do something on flexible budget. Flexible
For
budget.
question
I
2.
hope we can remember that they can give you a question that will require you to do high or low. You find the cost before you prepare the flexible budget. Charles, I hope you can remember that.
Yes, sir.
Ayo. Let's come to the question number 2 there.
Question number 2A. APZ has recently opened a fast food restaurant in a small town. Fast food restaurants are characterized by their quick food service. The fast food restaurant market in the town is dominated by a small number of long-established restaurants. APZ is seeking to grow its business and attract the town's residents with its burger meals. A performance report for the first month of business is to be presented at the restaurant's monthly management meeting. A draft of the performance report for the first month of business is reproduced below. So we have budget, actual, and then variance. And we have sales, that is number of meals they sold, revenue, variable cost, fixed cost, and then their profits. The management accountant at APZ has realized that the size of the fast food market that was used to derive the budget number of meals to be sold has been overestimated. The management accountant has calculated the value of the sales volume contribution planning variance to be 2480 adverse. So required, I, prepare a revised budget based on the new estimate of the market. II, prepare a performance report for the month based on flexed budgets. And III, explain 2 non-financial measures that APZ could use to monitor the performance of new fast food restaurants.
Okay, so this is a very simple one. This is whenever you are giving something like this, that what should come to your mind should be what? Should be the issue about what? Flexible budget. So you can see that they are saying that they are going to be selling what? 6,000, isn't it?
Yes, sir.
Based on the budget, and they have now selling what? 5,400, isn't it?
Yes, sir.
So you can see the comparison that they are doing over here is not logic. It's not appropriate. It's not fair, isn't it? Because they are incurring the revenue of selling 6,000 and the cost of 6,000 to 5,400. You can see that that particular comparison is not what? It's not appropriate. Okay, so what we have to do is that, okay, we are budgeting for 6,000 and we are now selling 5,400. So we have to find the respective costs and revenue that should be derived from selling what? 5,400. You cannot compare someone's BEC result in 2022 to someone's BEC result in 2024. They are all BEC, but they are different questions. So the only thing that you can compare is they have written the same examination. Okay, so these items over here are for 6,000. This is 5,400. You cannot compare cost of selling or revenue from 6,000 to 5,400. The best that you can do is to just bring all of them to the same one. Always will bring it to the actual results. That is the first part of it. But the issue over here is to prepare a revised budget. Revised budget on what? This is a budget at the planning level. This is a budget at the planning level. This budget has been revised and it has been given to what? It has been given to the operational managers now, and they have actually what? They have actually implemented and they have gotten this particular result. So what budget has been given to them? That is what they are asking us to do. That we should now prepare a revised budget. The revised budget will always be based on the what? On the budget, because the budget will be revised before giving to the people, before you have the actual result. Okay, let's now come here. The management accountant at APZ has realized that the size of the fast food market that was used to derive the budget number of meals to be sold has been overestimated. The management accountant has calculated the value of the sales volume contribution planning what variance to be what? To be 2480 adverse. How do we calculate sales volume contribution variance? You have to establish that particular one first. Sales volume contribution variance. Sales volume contribution variance. If our contribution is on 6,000 and now we are selling a particular amount, what it means is that we are either underestimating our contribution or overestimating our contribution. So the sales volume contribution is calculated as the budgeted quantity minus the actual quantity. In this case, our actual quantity will be the revised what? Will be the revised estimate. So we come over here to know so we now calculate our sales volume. So let me just write sales volume contribution margin variance. Okay, that is calculated as budgeted quantity. So if our budgeted sales that we are going to be using, budgeted contribution, the budgeted contribution is based on a particular amount. Now that was based on 6,000. Now let's say you are selling, let's say 6,500. It means that your contribution has been underestimated over here. So what is the underestimate? The contribution is already on 6,000. So what is the additional contribution that we have to be adding? That will be on 500. So we just see 6,000 is the contribution is supposed to be on 6,500, but we have only captured 6,000 in our budgeted profit. So it means that the contribution has been underestimated by 500. How do we get 500? We just find the difference and multiply it by the contribution by unit per unit if it is 5 cities. So it means that this has been underestimated by 5. That will give us 2,500. That is the idea about the contribution or the sales volume contribution or the sales volume profit variance, depending on the costing technique that you are using. So this is calculated as a budgeted. How do we get a 500? Budgeted minus the what? Minus the actual. But in this case, our actual will be the revised because we are calculating this under the what? Under the what? Under the planning level. The planning level, the budget is the estimate made by the top people. The actual is now what? The revised one. Then the estimate that has been made by the tactical what? Level managers. So from the tactical level to the top level, the variance that is happening over there, that is at the planning level before the thing will even go into operation. That is a planning level. So the difference over there is what we call the planning variance. But between the tactical level and then the operational level, so the plan will be revised at the tactical level, given to the people at the operational level. Then they will now implement it. The difference that is happening between the revised budget and then the actual is what we call the operational what? Variance. Okay, so we'll be looking at this one very simple here. So we come to this one now. So our actual over here will be a revised quantity. So let me just make this one to be revised quantity here. So minus the revised quantity multiplied by the standard what? Contribution. Standard contribution per unit. Standard contribution per unit. Okay. Let's come here. Let's come here. Okay, let's come here. So we are having our variance is what? Is adverse, which is negative, isn't it? How do we subtract before getting the negative? Let's come here. If we are having 6,000 and we are selling 6,500 now, would the contribution variance be adverse or it will be favorable? Our budget is 6,000 and this is now 6,500. Would that be favorable or it will be adverse?
Favorable.
That will be favorable,
It will
isn't it?
favorable.
Okay.
Yes,
So
sir.
this will be 6,000 minus 6,500. That will be favorable, isn't it?
Yes, sir.
Okay. In other words, if we want to make the favorable positive, it means that we have to now do 6,500 minus 600, 6,000, so that the answer that we are getting over here can be in positive. Because if you subtract like this, it will be positive. But if you are subtracting 6,000, if you are subtracting 6,500 from this one, this will be negative, isn't it?
Yes, sir.
But we are making it favorable. So it depends on how the positive or the negative that you are adding. It depends on how you have calculated the variance. So if it is budgeted against what? The actual, and it is what? It is favorable. What it means is that the actual is higher than this one. But in the normal mathematics, this should be give you a negative answer. So you make the favorable to be what? To be negative. Because 6,000 minus this one, the answer should be negative in terms of mathematics. Okay, so let's come here. The contribution is what? Is adverse. So it means that the budget is higher than the what? Than the revised, isn't it?
Yes.
Yes, sir.
So let's assume that the revised is, let's say, 5,800. This will be adverse, but in mathematics, in mathematical words or in mathematics, this will give you a positive answer, isn't it?
Yes.
Okay. So what you do is your figure will give you what? Okay. You now have 2, 4. Is it 80 or 20?
80.
Okay, that will be positive in terms of mathematics. So we have 6,000 here minus the revised what? Quantity. What will be our standard contribution per unit? Let's go to the question.
7.5.
7 points.
5.
Okay, how did you get that? Standard contribution, what are you having per unit?
Yes. You take the revenue 45,000 divided by the budgeted sales.
No, please. That is not how we calculate contribution. But Charles,
Hey,
how did you calculate contribution?
So we
sorry.
take the variable cost from the revenue,
Mm,
and then we divide the answer
divide.
by the units we sold, or the units we budgeted to sell.
So that would
6,000.
so that the contribution, let's get the contribution there because we are learning. Let's show all the details. Okay. So we come to our contribution, the standard contribution per unit. Standard is just like the budget, but the budget is always done on total basis. So standard contribution, but if you try to find it per unit, that is the standard. So standard contribution per unit. So we have our budgeted revenue, isn't it?
Yes, sir.
We have
45,000.
budgeted revenue of 45,000 minus what? Budgeted variable cost, isn't it?
Yes, sir.
Which you can call which you can also call the standard variable cost. What are we having?
26,400.
26,400. What will be our budgeted contribution?
18,600.
This 18,600 we divided by the number of units sold, isn't it?
Yes, sir.
What are we having?
3.1.
5.1.
Okay. So this will now be multiplied by 3.1. Okay, let's do some small mathematics here. 2480, 6,000 multiplied by 3.1. Is that cool? Then
Yes, sir.
minus 3.1 RQ, isn't it? Okay, we have 2480 is equal to, this will still be the same as 18,600, isn't it?
Yes, sir.
Okay, minus 3.1 what? RQ.
Okay.
The group items, 2480 minus this one, then negative 31 RQ. What are we having? From the left hand side,
Left side is 16,120.
16,120 negative. So negative 3.1 RQ. We divide through by negative 3.1, negative 3.1. What are we having?
5,200 positive.
So we have 5,200 units. So our revised unit is now 5,200. So preparing your revised budget, you now do it for 5,200. So you just do your revised budget for using 5,200. So let's come to A now. So we prepare our revised budget based on 5,200. Okay, this revise is still going to be based on what? On the standard, because the revise will be given to those people to do their operation now. So this is still before the what? This is still before the what? The actual result. So we come to our sales over here in volume. It has been revised to 5,200. Okay, let me take the Ghana city first. So this will be in units, 5,200. Then we come to our currency here. So we now estimate the revenue. Okay, let's go here. The revenue of 45,000 is based on what?
Based on
6,000.
6,000 units.
Okay, then 5,200 will now be what? Please, the revise will still be estimated on the budget, because the revise will be given to the people before we have the actual. So at the revised level, there is no implementation of the budget now. So if we have 6,000 for 45,000, now we are reducing our budget to what? Our budget to 5,200. Then what will be the revenue? You just come here and have 5,200 divided by 6,000 multiplied by 45,000.
39,000.
30.
You have 39,000.
Okay, 39,000. Then we come to variable cost, isn't it?
Yes, sir.
The variable cost will be 5,200 divided by 6,000 multiplied by
26,400.
26,400. What are we having?
22,880.
22,880.
880.
What will be your contribution? This is management accounting for management decisions.
16120.
16.
120.
What will be our fixed cost? Just what will be our fixed cost? How do you get a fixed cost, just?
So the fixed cost is still going to be 5250,
Okay. Why?
because we are actually absorbing based on marginal costing.
Okay. So the fixed cost is whether you are producing 1 unit or not, it will still be what? The same. Fixed cost does not vary with what? Output level, unless it's a step what we call fixed cost, where if you are producing or if you are exceeding the capacity, the additional one will come with what? With a fixed cost. So that will still be 5250. So we don't flex the fixed cost. What will be the profit?
10,870.
Then it's
70.
okay. So this is a revised budget, but the B part. Okay, let's now go to the B part. So the B part, what is going to happen is that the B part, you have to do it as if there's no what? There's no revision in the budget, because if you are looking at the issue now, if you want to do it, you can see that there will be a variance at the planning level and there will be a variance at the operational level, because the operational, our budget is now 5,200 and they have now sold 5,400. That will also be a variance. Okay, so you can see the variance in total over here will be this one. Just pay attention to this one. You can see the variance between the planning level is 6,000 against 5,200. That will be 800 units or 800 meals, isn't it?
Yes, sir.
Okay. Now from the revised level to the operational level, now the operational variance will be a positive 200, isn't it?
Yes, sir.
If you net the two, what are you having?
Variance of 600.
Okay, the 600 is the same as what? The budget itself and the what?
Actual.
Okay, so if you are talking about variance, the variance we are talking about the variance in total. But if you want to do it one by one, that is going to be taking your time. If you want to do 5,200 against 5,400, okay, this is just the operational level. This is the variance at the operational level. But what was the variance at the planning level? The people are saying that they should produce 6,000. They should produce and sell 6,000. Now they have produced 5,400. The total difference over here is 600. But if you want to separate this, then it means that you have to do first 800, which will be between the planning and the what? The planning and the tactical and then the top level. Okay. At the end of the day, the actual budget for the period is 6,000. But just that you have given the thing to the people are saying, no, based on the things that we have in store, we cannot produce the 6,000. So it means that you have overestimated your this thing by what? 800. So that is a variance there at your side. Come to the operational level. We have given them 5,200. They have now produced 5,400. There's also a positive movement there. So you net the positive against the negative. In total, what is the variance? What is the difference in total? That is it. So you just do between the budget and the 5,400, because if you want to do one by one, that will be taking your time. And you can see that the effect has actually been reduced to what? To 600, which is the difference between the budget and this one. So the budget, what we do is we are going to be doing this based on flexible budget. So we have a flexible budget. We now bring our budget to the actual level. So we have flexible budget over here to be, okay. So we have our demand. So we're having the flexed budget over here. Flexed budget over here. Okay, so you'll be having your flexed budget over here. You'll be having your actual budget over here. Then you'll be having the variance now. So this is how the budget is supposed to be prepared. The budget is supposed to be prepared on a logical basis for comparison. You cannot be comparing a cost or revenue that you are saying that you are going to be receiving from 6,000, sell off an item with what? 5,400. That is not making sense. So you compare based on your budget. How much should have been received for the 5,400? If you are selling at your budgeted selling price, how much are you going to be receiving for the 5,400? Then you compare with the amount that you have received. If you understand the flexible budget very well, there's no way you should be having problem with what? Problem with the standard costing. So we come here and have our meals over here. You always have to show the this thing that you are selling. Okay, so let me just bring the meals over here. Number of meals. We are now limiting these to 5,400. We are comparing our budget with the actual, which is 5,400. This will be dash. So let's come here. We have our currency sign here. Our currency sign here. Our currency sign here. And our currency sign here. So we start with our revenue. So the revenue, you are not going to be doing workings for the actual. What is the actual revenue?
40,365.
40,365. Okay. What is the variable cost? Actual.
24,632.
24,632.
632.
What will be your contribution based on the actual?
One five seven three three.
15,733.
733.
What will be your fixed cost? Actual.
4950.
4950.
50.
Okay. What will be your profit based on the actual?
10783.
783. Okay. So we now have to flex our what? Our budget now to 5,400. Okay. How much are we saying that we are going to be selling? Okay. What is the selling price? Well, how much are we saying that we are going to be selling 1 unit of the meal based on our budget? How much are we selling 1 meal?
45,000.
How much are we selling 1 meal? The price of a meal is
7.5.
that will be 7.5, isn't it?
Yes, sir.
So we have sold 5,400 now. What should be the total revenue?
7.5.
40,500.
40,500.
Okay. So the 7.5 that you have calculated over here, what we call the standard selling price So if you reduce your budget per unit, that will now give you the standard selling price. So your standard, if you don't want to sell at all, it should be sold at 7.5. Now you have sold for 5,400. How much should be received? That will be 7.5 multiplied by this one. But you have received this amount. Are you making profit, or are you receiving more, or you are receiving less? Which can also be calculated like this. So if 6,000 is 45,000, 5,400 will be equal to what? So you can find a per unit. That is what you are mostly going to be seeing under the standard costing. Okay, so you come here and do a revenue over here. We can do 5,400 divided by 6,000 multiplied by the total, isn't it? Okay, so you can actually do 5,400 divided by 6,000 multiplied by 45,000. I'm sure you'll be getting the 4,500, isn't it? Okay, so I'll just do, you have to go and do your workings for this one somewhere. So 5,400 for the revenue, that will give us 5,400. So let me do some small workings here for revenue. Revenue will be 5,400 divided by 6,000 multiplied by 45,000. Charles, what are you getting? 40. Charles, is it the same thing?
40,500.
Okay, 40,500. This is the same as 45,000 divided by this multiplied by this. What about a variable cost? Variable cost is what? 25,400 divided by 6,000 multiplied by 26,400. What are you having?
23760.
23.
760.
Okay, which is the same as 26,000 divided by 6,000 multiplied by what? Okay, 23670.
Yes, sir. No, it's
Okay,
23760.
760. Okay, that is the same as what? So you just find the what? The cost that you are going to be incurring per what? Per meal. The variable cost that you are going to be incurring per meal. So that would be the 26,400 divided by 6,000. Now you are producing, you are making and selling 5,400. What would be the cost there? So you have 23,760. What would be our contribution? What would be the contribution?
16740.
16,740.
740.
What would be our profit?
11490.
11490. Let's find the variance now. Okay, are we receiving more? Would that particular variance be favorable or adverse?
Say an adverse.
Of how much?
Is it the revenue side?
Yes, please.
Revenue side
It's
adverse of
favorable.
135.
135. So you can do it adverse or you can put it in bracket. But let me just do it adverse. Okay. So we have our budget over here to be adverse. Okay, the cost.
So it's not. Okay.
The cost
is
has
what?
872 adverse.
The cost, are you sure is adverse?
Yes, sir. We budgeted for 23760 and ended up spending 24632.
It's favorable.
No, please. It's
It's
adverse.
Not
adverse.
favorable.
Contribution is what?
1007 adverse.
Okay. So we have 007 adverse. The fixed cost is what?
First cost, we have 300 favorable.
300 favorable. Our total will give us what?
707 adverse.
Okay, 707
7 adverse.
Okay. 707 adverse.
Um, um,
707. 707 adverse.
Yes,
Is
sir.
someone talking?
Yes, sir. Please, I want to ask, are we taking the actual from the budget or the budget from the actual to get the variance?
Anyhow you do it, you have to be getting the same answer.
Yes, but it has to do with the adverse or the favorable.
So what
That's
do
all.
you what are you getting? If you do it, are you getting an answer different from what we are getting?
No, I'm getting the same answer, but as to whether to get the adverse or the favorable, that's the issue.
We just compare the standard with the actual. Okay. So whatever you are comparing, this is the amount that you have to spend, this is the amount that you have spent. So you either determine whether you are overspending or you are underspending. Okay.
So when we take the revenue, we budgeted for 40,500,
Okay.
but we actually spent 40,365. That meaning
Okay.
we have a favorable balance of 135.
How can you
But
tell us this story? Your father is supposed to give you 40,500 and he has given you 40,365. Is your father giving money to you in excess? Revenue is not a cost. If the company is selling more, that will be in favor of the company.
okay.
Mr. Linus,
Yes, please.
the thing is that if you are trying to get the variance, you should first bear in mind that sales, if it is a revenue, how do you get the variance? If it's a cost, how do you get the variance? If it's a revenue whereby the actual exceeds the budgeted, it means that you'll be getting favorable. But if it's a cost and then the budgeted is less than the actual, then it means that you'll be getting an adverse. So you should first ask yourself, is the item a revenue or is a cost? Then you can determine the variance.
Is that one to me or to the
To
person?
the yes.
To the person, isn't it?
I'm moving on.
Okay. Okay, let's come to just the third one. Explain two
You think
non-financial measures that APS can use to what?
to monitor the performance of the new fast food restaurant,
So after you are done, give us one.
we could look at the rate of employee turnover, and we could look at the customer satisfaction as well.
Only one. I say only one.
Oh, okay. Then employee turnover.
So Charles has given us one. Someone should also give us. They say two. So at least let's have four.
Number of referrals.
Number of what?
Referral.
Okay. Okay. So he's saying the referrals that are going to be coming. Okay. Quality of meals sold. Okay. What again? You are not going to be talking about the rejections, the meals rejection received for a
Yes.
particular period, and also the repeated what orders that are going to be received from what from the place. The cost of a meal can be measured. We are talking about non-financial. Anything that has to do with cost is something that is financial. So cost of a meal is what is a financial measure, not non-financial. So we talk about the rejections that has been received, the repeated orders that have been made by the existing customers. So we can look at our retention, the retention rate, and other issues. Okay. A company uses a top-down approach. Just take that question B for us.
B. A company uses a top-down approach to budgeting. Budgets are imposed by senior management, and budget holders are not given the opportunity to participate in the budget setting process. Required, explain one advantage and two disadvantages to the company of using this top-down budgeting approach.
Just what do you mean by top-down budgeting approach?
It's that method of budgeting where the top-level management just drafts the budget to be implemented by the bottom level without their opinions or their suggestions, and it's just imposed on them.
So what is the opposite of the top-down budgeting approach?
Bottom top.
Bottom top. Okay.
Yes, sir.
Okay. I was thinking you mentioned a different thing. I was thinking you mentioned a different thing like participative budgeting. So that is also called a participating budgeting. Okay. So let's come to the advantage. Charles, do you think that is good, and do you think it's not good too? Everything has both positive and negative. So what is the good side of it?
The good side of it is that it saves time.
Okay. It saves time. Okay. They say you should state only one. So it saves time. What again? Let's have three.
It also reduces the budget slacks, since we don't need the opinions of these managers who try to tweak the budget to their own preference.
Okay, who will not what are you saying to okay. There will not be any issue of budget negotiation, which will be negotiating the budget based on. But what you are saying is also correct, but just that okay, it's also correct. Fine. What again? Let's have three. Errors are reduced. Okay. The errors are reduced and okay. So errors are reduced. It saves time. It's very simple, not simple. It is very quick to prepare. That is fine. And it's also okay. That is fine. The errors are reduced. It is less costly, and there's no issue of budget slacks or budget negotiation, because since the idea of the views of those people are not going to be considered, there is not going to be an issue where someone will be suggesting what he or she can do. Okay, no, there will not be any issue like that. What is the disadvantages? What are the disadvantages?
Sir, the disadvantage,
Yeah.
can I say lack of understanding and difficult to implement? Because
Yes,
hello?
Yes, please.
Because
Okay, you can go ahead to explain so that maybe you can
because at the
convince me.
management level, they sit at the top and draw the budget and impose it on the junior officers. So the junior officers lack the understanding, which also makes it difficult for them to implement.
Okay. But whatever will happen, there might be some sort of training, but the understanding that they will be getting if they are involved in the process will be better than the kind of training that you are going to be giving to them, most especially the government school teachers. Okay, sometimes they will say they should come for workshop, they will be doing their own thing, because they will say that they were not consulted, and they just brought a curriculum that they should implement. So they will be doing what they want to do. So that understanding of the issues will not be there. So that is fine. That is fine. All right. Someone is saying that there is no motivation to employees. Targets will be set at a higher level of employees not to meet targets. No. Targets, if you are setting a target, the people there, they know the employees that they have. So target might not necessarily be set at a higher level for them, but just that they want to reduce the time. That's why they are producing the budget themselves. Okay. But if you don't have issue, you can actually
Can we say
put that
lack
one
of
there.
participation?
Lack of what?
Participation on the side of employees, because the budget may not favor them. So
The budget will not favor
them because their ideas weren't factored in creation of the budget.
and that is the issue about the motivation.
Okay.
Yeah. Okay, it may not be realistic, that is fine. It may be difficult to implement because we are not there, so we don't really get an understanding of that one. So that is the understanding part. Motivation too will not be there. Management might be biased. Okay, there might be an issue of budget negotiation there. So since every manager is going to be, if he's a divisional manager, he also have objectives to achieve. So he will not be negotiating what he will be focusing on achieving his own than the overall objective of the organization. So if you go there, they ask you this question, just try to write something there, but you should just maybe you can put yourself into the situation that you are in an organization where they are using this particular approach. If the budget is being prepared and they are asking you to use it, what are the things that will happen? Okay, so you can be able to get an answer there and use it for whatever.
Sir, can you also,
yes,
sir,
yeah.
Can you also say lack of expertise, which could also end up in high cost of training?
The employees are not having the
expertise to understand, so they have to maybe train them, which could become expensive.
Yeah, that can also be a factor depending on where the budget is being set.
Okay, sir.
All right. So Charles, I just want to talk about the question number 3. I will not solve. It's a past question. So I'm sure November something there, maybe 2020 or 2021, I don't know. But I'm sure it will be 2020 or 2019. Okay. So just read that one for us.
Question number 3. The following monthly budgeted cost values have been taken from the budget working papers of ABC Limited for the year ended 30th September 2019. We have activity levels of 75%, 85%, and 95%, all with their respective details. So during September 2018, actual activity was 1,292 units, which was equal to 68% activity. And we have the actual details under that. We have direct materials, labor, expenses, production overhead, selling overhead, and administration overhead, all reflecting the actual performances. So required, prepare a budgetary control statement for ABC Limited on a flexible budget basis for the month of September 2019.
This one, sometimes the question will not ask you to prepare a flexible budget. They will just ask you to prepare a budget suitable for what? For analysis. Budget suitable for analysis. They are giving you a result. Okay, please. Why am I bringing this question here? Because I received some solution from people where they are trying to change the 85 to what? They are trying to change the 75, 85 to units. If you are changing this one, it's not the same as the 68%. The 1292 unit over here is not the same as 68%. Just it's not the same as the 68% here.
Yes, sir.
If you are converting the percentage to unit, it's not the same as the 75% of the total units that you are converting to the unit for the 75%. If you want to change it, you are going to be grossing this amount to 100%, isn't it?
Yes, sir.
And 100% will be 75% of this 185. It's not better to express everything in percentage now, since you are giving percentage. It's not better.
Yes, sir.
If you are doing this one, grossing this one to 100%, it will be the 68% of this one will be the same as the 75 or 85% of everything. So why are you grossing? They have given the unit to you, they are giving the percentage equivalent, and they have given you the percentage also over here. If you're using high-low, The high-low will always not be given to you in units, in hours. They can any activity level, they can give you different activity level. It can be in hours, it can be in units, it can be in percentages, it can be per head, it can be the number of people that they are giving to you. But just that activity level will be more than one. That is why we use high-low. Simultaneous equation. Okay, so this question is about high-low, and your actual activity level is what? Is 68%. Okay, is 68%. And these are the costs over here. So what we have to do over here is that you are given 3 different activity levels. So the cost for each activity level might not be the same. So we have to find that particular one cost per percentage that we are going to be multiplying by the activity level over here. So we'll be using these to find our variable cost and fixed cost for each activity level or for a percentage. What are we getting? So you use high-low. High-low, if you are doing high-low, what you have to do is that sometimes the direct material, direct labor, direct expenses, sometimes will be what? It will be the same because they are variable costs. So there will not be any fixed element over there. So what you have to do first is that you have to test to see whether that particular cost will be purely variable. Test to see if all the costs are purely variable. What do you mean by that? They are purely variable. If they are purely variable, it means that the cost per percentage for direct material will be the same as per percentage for this one, per percentage for that particular one. Okay. Okay, so what you do over here is this one. So let's come here. Let's test this one to see whether this is purely variable. So we have 93.75 divided by 75. We check to see whether this will be the same as 10.625 divided by 85, and also check whether this will be the same as 11.875 divided by 95. Just are they the same?
No, sir.
Are you sure?
They are 125.
They are 125 throughout,
Oh, yes.
isn't it?
Yes.
Yes.
Okay, so it means that there is no fixed cost over here. There's no fixed cost over here. So this cost is strictly variable. So if you come to your what? If you come to your, let me show the flexible budget over here. So I'll show for only material because we check that one too and see whether it is. So you come to your flexible budget over here. You come to your flexible budget over here. You have your flex budget. So you have your flex budget over here. You have your actual budget. Then you have your variance over here. So your output level will now be 68%. You limit this thing to 68%. So you have dash. If you are changing 0 to 1 to what is the output equivalent of that one? 1292.
1292.
Okay. 1292. If you are changing it to 100%, that will be 0.68. What are you having?
$1,900. 1,900.
You're having 1,900, isn't it?
Yes, sir.
And this 1,900, you find 75% of it, 85% of it, 85% of it. Okay, so find the 75%. Let me check. Let me see there.
1425.
1425.
25.
Okay. The answer that you are going to be getting over here will be per unit, isn't it? Okay.
Yes, sir.
If you want to get your output to, it's no 0.68% of this one. That will give you 1 to this one. So you can, instead of using units, you are now using percentage. So just use the percentage straightforward. Because the 75% of the 1,900 is the figure that you are using to find the cost per unit. Why do you like to be doing what? Complicated things. The percentage are the same. So yeah, there's no difference over 68% of the total, 78% of the total. So it means that 1% of the unit is the same as what? It's the same as 1% of the unit for the 68% too. So just limit your this thing to the percentage. Okay, so we have that particular one, and you do your cost per that one now. So let's come to We have the output, then you bring your cost over here. You bring your cost over here. So what is the direct material? What is the material cost for the actual? The actual, we don't do anything. What is the material cost?
10,500.
10,500. But we know that based on the what? Based on our fixed budget, 1% of what? Of a material is what? Is 125 Ghana cedis, isn't it?
Yes, sir.
And we are doing this for 68%. So just multiply by 68. The figure that you are getting is per percentage. So just multiply by 68. What are you having?
8,500.
8,000.
500.
So you have your 8,500 over here. And you have 2,000 as what? As a variance, which is adverse. So you check the direct labor also and see whether it is purely what? Variable. Direct labor too, are you having the same figure for all of them? Direct labor per percentage.
Yes, 150.
Okay.
150.
So it means that it's purely what? Variable. So you just come to this place. So if 150 is 1%, so for 68%, what are you having? Once 50 multiplied by 60, that will give you the what? The flex amount. Direct expense. I'm sure direct expense will be giving you the same thing because anything direct must be giving the same answer. If there's a variable cost, then they will just give you material. Then it means that there will be some direct and indirect cost there. The direct expense is what?
65.
It's the same thing, isn't it?
Yes, sir.
Okay. So that one too, if you want to get a flex, that will be the what? The cost per percentage multiplied by the percentage that you are calculating for. Administration overhead over here. What is the meaning of that?
It's fixed.
It is entirely what? Fixed. No variable cost there, isn't it? Okay.
Yes.
Try the
Yes.
production overhead. Production overhead will not give you the same answer. Okay. So there is a variable production overhead over there and fixed production overhead. So how do we separate it? We have done this. We say that it is simultaneous equation that we are using that we arrive at the high-low, Charles, isn't it?
Yes, sir.
Okay. So what we do over here is that we have high-low, highest level of activity with its associated cost, and the lowest level of activity with its associated cost. So the highest level of activity here is what?
95%.
So what is the cost of the production overhead?
7,000.
So you have 7,000. The lowest level of activity is what?
75%.
With a cost of what?
6,200.
6,200. Okay. Then divided by 95% minus 75, isn't it?
Yes, sir.
So we are
20.
having 800 divided by 20. The variable cost per percentage for production overhead is what?
It's 40.
It's 40. So you have to come and check. Okay. You see this figure over here are total cost. This figure over here are total cost. Okay. This figure are total cost. So you just use any of the activity level to calculate that. So this is what you do. Okay. So you can use 75%. If this particular cost should have been what? A variable cost, it should have been 40 multiplied by 75. So this cost over here is total cost. How do we calculate total cost? Total cost is the total variable cost plus the total fixed cost, isn't it?
Yes, sir.
So you come over here, total cost is 6,200. Our total variable cost will be the cost per percentage multiplied by the percentage. So 40 multiplied by 75 plus the total fixed cost. So what will be our total variable cost?
$3,000.
3,000.
Okay, 3,000. It means our total fixed cost is what?
3,200.
Okay, so 3,200 is the fixed cost. So for you to get the flex amount for this particular one, this is what you do. So you know that every unit every percentage is 40. So you just do 68 multiplied by 40. That will give a variable cost. Then you add your fixed cost to it because you are looking for total cost. These are total costs over here, total variable cost plus total fixed cost. So you know that for every percentage is 40. So I'm doing 68. That will be 40 multiplied by 68 plus the fixed cost. Then you get that particular one. That's how we go about it. A very simple one. Okay. I'm sure it's 2020 November or 2019. So you can go and check there and see what you have over there. So you can go and check the solution there and you see what we can do there. So let's come to, they have now added some parts in the budgeting, that is preparing budget for the what? For the public sector.
Public sector.
Okay, so they can actually give you a cash budget for a district assembly. It is same as a cash budget. You just have to determine their what? Their revenue, their expenditure, and they will give you how this amount will be settled. The same figure over here. But let's look at this complicated one. Just question number 4.
Question number 4. A government ministry has provided the following information about its budgeted actual overhead and personnel costs for 2014. We have actual and budgeted for the following details there. Then the following information is also relevant. A. Increase in 2015 activities will attract 15% overhead cost. B. 12% of total salaries in 2014 is required to meet the additional personnel cost in 2015. C. The personnel cost of the year 2014 include 945,000 Ghana cedis spent on staff allowances. The staff allowances will attract 25% of 2015 staff salaries. D. However, an inflation of 10% on overhead cost is recognized in the computation of 2015 budget. E. The current level of capital assets would be enough to support the activities in 2015. So you are required to prepare on the incremental basis the budget for 2015 using actual results.
Okay. So this one, they can give you this question and they will not ask you to use the actual result. Please, if you are given a question like this, you cannot trust these people. Use the actual result because of what? This one. Okay. So they say the personnel cost of the year 2014 include 945,000 spent on what? Staff salaries. Spent, it means that is the amount that we have paid. Okay, so you use the actual. Though you can use budgets and also the actual. They might give what? The marking scheme might be what? Might be giving allowance for the two, but to be at the safer side, please use the actual results. Okay, but let's come to the issues that they are talking about over here, one by one here. Okay, let's come to this one. A government has provided this and this. So they say this is for actual overhead. It's budgeted overhead and personnel cost for what? 2014. So compensation. Okay, compensation, they are talking about compensation for employees, isn't it?
Yes, sir.
All right. Then goods and services are those administrative and other what? General expenses. Okay. So let's come here. They say increase in 2015 will attract what? 15% overhead what? Cost. Increase in what? 20. So this is what we are going to be doing over here. So let's prepare the budget for 2015. Okay, question number 4. Public sector budget. Okay, so we have so let's have the course here. Are they keeping 3 zeros?
Yes.
Okay. For government, they like writing figures. That is plenty. So let's come over here. We have the figure over there. So this will be for 2015. So budget for our 2015 budget. 2015 budget. Okay. That is what you are going to be doing over here. Okay. The compensation, you can see that they are giving us some information on the compensation. So for The purpose of this one, what we are going to be doing is that we are going to be separating salaries from allowances, because they are giving us information on allowance and also what? Also salary. So we are going to be, or we can go and do workings for that one. Let's do workings for each of them now. And we come to the compensation. So let's come to workings over here. So we have workings. Just can you still remember the answers for this one?
No, sir.
Me too, I forgot to know. Okay. So compensation will be having salary under the compensation, and we also be having allowances. So they have put all of them together. Okay. So let's come to this one. Let's take the first one there. Okay. Increase in 2015 activities will attract what? 15% overhead cost. So we have to now know the overhead cost that we are going to be incurring in 2050, and that will be attracting additional 15%. So we go there and see that particular one. 12% of the total salaries in 2014 is required to meet additional personnel costs in 2015. 12% of the total salaries in 2014 is required to meet additional personnel costs in 2015. Okay, the personnel costs of the year 2014 include what? 945,000 spent on staff allowances. Staff allowances will attract 25% of 2015 staff what? Salaries. Okay, staff allowances will attract 25% of 2015 staff what? Salaries. Okay, please, your salary is different from allowances, isn't it?
Yes, sir.
Yes.
Okay, so they are saying that 12% of the total salary in 2014 is required to meet additional personnel costs in 2015. But the personnel costs over here, the 2014, what are they giving to you? 2490, isn't it?
Yes, sir.
It's including allowance of what?
945,000.
Okay, so what will be the salary in 2014? What is the amount spent on salary?
1545.
So I have 2490 minus what? 945, isn't it?
945.
Okay. They said this will be increasing by what?
12%.
Okay, so what you do over here is you multiply by 1.12. Do you agree?
Yes, sir.
Yes.
Okay, so 12% of this one, we are still going to be maintaining the what? How do we calculate incremental what? Budget? How do we prepare incremental budget? We add allowance to the previous year's own. So it means that additional staff salaries or additional employment, or we might be employing people in the 2015. So that is going to be bringing 12% increase in the previous year's what? Salary that we have paid. So we are going to be maintaining the people that we have used for the previous year. We are going to be maintaining them here, but we are going to be incurring additional cost of 12%. So what are you having if you do the 12%? What are you having there?
1730.4.
1730.4. Okay. So we have 1730.4. Okay. I hope that is cool for the first one. Okay. We now come to the issue of the salary now. 12% of the total salary in 2014 is required to meet the additional personnel costs in 2015. So it means that in 2015, we are going to be what? We are going to be spending 112 of the amount that 112% of the amount that we have spent in the last year. Okay. So that is that for that particular one. Okay, let's come to the personnel cost of the year include 194 spent on staff allowances. So we are looking for salaries, 12% of the total salaries. The amount that you are paying, if you come to work, how much are they paying you? The allowances is any other issues that you are giving to you. So that should be taken away from the total personnel cost. Then we know the salary. So we have done that now. And they say the staff allowances will attract 25% of 2015 staff salaries. So let's come there. What is the 2015 salaries now?
1730.
So 0.25 multiplied by
1730.4.
1730.4.
okay 1730.4. Okay,
Yes, sir.
what are you getting?
432.6.
43.
432.6.
Okay, let's come here. Someone can calculate all of these things like this. The person can do the composition like this. Okay, the person can do the composition. The person can do composition like this. The person will do 2490 minus 945 multiplied by 1.12 multiplied by 1.25. Check that one. Look at it and think about it.
Yes, sir. But when you do that, you ignore the initial 945,000 of the staff allowances we paid last year.
Yes, that should not be part. That is now increasing. Okay, so the staff allowances now, okay, the staff allowances now, the only one that we are going to be paying this year, the staff allowances that we are going to be paying, the staff allowances will attract 25% of what? 25% of 2015 staff salaries. That's what we are going to be paying for this year. It means that the staff allowances will be reducing now.
Okay, sir.
Okay, not all if you count to the incremental, some of them can be reducing, some of them can be increasing. Okay, so we are going to be reducing our allowances, and the allowances will be only 25% of that. So we are not going to be adding the 945 again.
All right, sir.
Okay, all right. So what are you getting for the compensation?
2163.
2163. So we now come here, we have compensation. 2163. So you can see workings 2163. Okay, the rest of them, we can just write the items and do the calculation in their respective brackets. So let's come to goods and services here. Goods and services, what is the first one?
First one is traveling and transportation.
Traveling. And this is where the money has been passing. Okay. Traveling and transportation. So the next one is what?
Utility services.
Utility services. What are you having?
No, telephone services.
Telephone.
And stationery.
Telephone services.
Stationery.
That's all.
So maintenance of vehicles. Maintenance of capital assets.
Maintenance of vehicles. And
maintenance of capital assets.
Maintenance of capital assets.
Staff training and development.
Staff training and development.
The last item there is an asset item.
So they say that one is, there won't be any acquisition of what?
Yes.
There won't be any acquisition of capital asset again.
Yes.
The office furniture will not be. So you can see that they are actually reducing this one now. Just I hope you can see that now. So incremental doesn't mean that we have to increase all of them, but those that are going to be incurred again, we increase those ones that. Charles, are you watching the quiz?
No, sir.
Okay. Okay, so let's come to the issues now. Let's come to one of them now. Okay, increase in 2015 activities will attract what 15% overhead cost. Increase in what? In 2015
activities
will increase in 2015 activities will attract 15% overhead cost. So it means that we are going to be doing more of the administrative issues in 2015. So it means that our cost will be increasing by 15%, isn't it?
Yes, sir.
Okay, but let's come to this place also. down to this one.
Mhm.
However, an inflation of 10% on overhead costs is recognized in the computation of 2015 what? Budget. So the 2015 that we are doing now, it will be based on the additional activities that will be coming. But the salary will also be increasing. So we are going to be doing additional traveling. We are going to be doing additional traveling in what? Additional training. We are going to be doing more of the training, more of the traveling. All those things will now increase in 2015. So our overhead costs will increase by what? By 15%. But this particular overhead increment, it is based on last year's figure. So we are saying that the price of the fuel will be increasing in that particular year by 10%. So this is what you do for each of them. You calculate the 15% on each of them, then you now inflate it by 10%.
10%.
So you increase all of them by 15%, then you still increase by 10%. It's just like you are saying that, okay, this year you are going to be doing traveling, and the traveling will cost you what? 2,000 Ghana cedis. So you have been able to visit only 5 regions. Now you say that you are going to be increasing your traveling. So increasing your traveling means that the cost must also increase. So you are saying that this cost will increase by 15%. That will be 1.15. This cost is based on last year's figure. So you are estimating the increase, the traveling cost for the increase, as if you have done the what? You have done the traveling in the last year. But the price of fuel will be increasing. Therefore, the transportation cost will be increasing. So they are saying that the price will now be increasing by 10%. So that will be 1.1. So if you want to get a total amount, you have your 2,000, you find your 15% and add, then you find 10% on what? On this figure, 10% on this one. Or you first of all find they are all multiplication, so you'll be getting the same answer anyhow you do it. So you find the 15% as the increment, then you now inflate it by what? By the 10%, or you calculate the 10% on it and now inflate the 2. Anyhow you do it, it's a multiplication, so you'll be getting the same answer. So you add the 15%, then you now inflate the 2, because the increment is based on the last year's figure. So they all be increasing by the 10%. So you calculate 10% on this one. In other words, just increase by 1.1, 1.15 multiplied by 1.1. Okay, so let's take the transportation now. Just
So
transportation.
transportation is 1030.
1030. Okay, multiplied by 1.15, multiplied by 1.1, isn't it?
Yes, sir.
Okay.
1302.95.
1302.95.
02.95.
Okay. Give us the utility service.
317.5.
317.5 multiplied by 1.15 multiplied by 1.1.
So 401.64.
401.64. Okay.
2625.
2625 multiplied by 1.15 multiplied by 1.1.
3320.63.
3320.63. Okay.
986.
986 multiplied by 1.15 multiplied by 1.1.
1247.29.
1247.29. Okay.
635.
635. Okay. 1.1 multiplied by 1.1. What are you having?
803.28.
803.28. Okay.
1182.5.
1182.
Yeah.
Yes, please.
As far as we are handling 3 zeros, in a situation where you have 3 decimal place, it's good to leave it at the 3 decimal place.
Yes, please. Or you change all of them to the 1,000 now. So whatever decimal that you have.
Because the A03.28 is 3.75.
Okay,
And
so
then the same as to the stationary.
okay, senior. So the issue is, upon all the problem that we have in this country, your own is about the decimal places. Okay. Okay. If you run
It's
it to,
money we are dealing with you.
no, Ghana cedis, the approximation is always to 2 decimal places. Okay. So nobody is going to mark you down for running these to 2 decimal places. Okay. Nobody's going to, unless the person is having a marital issues and they have given the paper to the person to mark. Okay. Since it's to 2 decimal places, for the Ghana cedis, mostly we write it to 2 decimal places. Okay. So even if you want to write it in full, there's no problem. So right now the 2 decimal place is okay for now. Okay. So just give us the maintenance of the capital one now. What are you having there?
1495.86.
1495.86.
Staff
Okay.
training is 1725.
1725. Okay, what are you having?
2182.13.
2182.13. So you just add all of them, that will give you the budget. Please pay attention to this one very well. Okay. I'm not saying that it will come, but they have added a topic that is what? Budgeting in the public sector budget. And you can see that this is about public sector budget, but they are making it to be what? To be incremental. Just pay attention to what the footnote is telling you. Okay. It is very important. Okay. Any issue? Then we now pick some questions on standard costing, and by trader we close. All right.
Yeah, you know do functional budget.
I've done the functional budget in class. So if I want to do functional budget, I have to close at, it's 152. I have to close at this one. I mean, this question, we solved it last sitting. So I'll just share the link to that one, then you just go and watch. But for now, let's do something on budgeting too. Let's revise something on budgeting too. So the budgeting, what we have to do over here. We have to,
Standard cost.
okay, no, standard costing and variance analysis. But I want to, you see, we know that if you are preparing a reconciliation at the same time, we are calculating the basic variances, isn't it?
Yes, sir.
So I want to pick the one that, if we are calculating, like we can have a fixed cost in it. We can have a fixed cost in it, and we calculate all the basic variances together.
That will be question 1.
That will be the question 1. But this one, for the reconciliation, the company is using, they are using marginal costing, but they say we should recalculate the fixed production overhead variances.
Marginal costing.
I mean, assuming they are using what? Absorption costing. Okay, this can actually help us. But the question 2 also help us more. But let's see the ones that we can do, and we see. Okay. This one, we also have to calculate this capacity one again. It's also, anything can happen. So I will just do the ones that I haven't done, because last sitting too, we did standard costing and variance analysis, isn't it, together? Okay. So if I just have to share that one, you go and watch, because we have solved many of the questions there. So we didn't solve the 4, we didn't solve the 5, but we solved the 6. Okay, the 7 too is about reconciliation. So we solved the 8 too. No, we didn't solve the 8. We solved the 8 in class. 9 we solved last sitting. So let's do some things to revise. At least we can actually revise those things that we have done, especially the basic one. They can give you a question on basic one. So let's look at the one now. Just pick the one for us.
So question number 1. Toma Paste Nigeria Limited produces tomato paste, which serve as an alternative for an immediate stew for working mothers instead of looking for fresh tomatoes. For the forthcoming period, the company's budgeted fixed costs were $600,000 and budgeted production and sales were 13,000 units. The product has the following standard cost. So we have selling price of 500, material that is 5 kg at $40 per kg to be 200. Labor has 3 hours at $40 per hour to be 120, and variable overheads 3 hours at $30 per hour to be 90. Actual results for the period were as follows. 1. 11,000 units were made and sold, earning revenue of $5,720,000. 2. 66,000 kilograms of materials were bought at a cost of $2,970,000, but only 63,000 kg were used. 3. 36,000 hours of labor were paid for at a cost of $1,422,000. 4. The total cost of variable overheads was $1,170,700, and fixed costs were $400,000. 5. The company uses marginal costing and values all inventory at standard cost. Required: A. Prepare a statement reconciling actual and budgeted profit using appropriate variances. B. Recalculate the fixed production overhead variances, assuming the company uses absorption costing. And C. Discuss possible causes for the labor variances you have calculated.
Okay, so this one, pay attention to this one, okay? Sometimes they will not tell you the question is using they will not tell you that the company is using marginal, but you look at the cost setup, the standard cost setup of the entity. So if I'm talking about a standard cost setup, you can see that it's about selling price and variable cost, isn't it? If you
Yes,
look at
sir.
the standard cost setup over here, so if you have this particular setup, then this will actually tell you the entity is using marginal. But if you should have a setup that is including fixed overhead, then that should tell you the entity is using what? The absorption what? Costing. So this one sometimes they will not tell you, or by to be specific, they will tell you that so they will tell you, okay, they will tell you that particular one. In this case, they are telling us. So they are asking us to prepare a reconciliation statement. So just go straight forward and do your reconciliation statements. So we come to the reconciliation statement over here. So let me start from this place. The standard costing question on standard costing. Okay, so we have the A, question number 1A. So profit reconciliation statements. Profit reconciliation statements. For the profit reconciliation statements, profit reconciliation statements, we always start with a budgeted what? Contribution or budgeted profit, depending on the what? On the costing technique that they are using. And the question is telling us that they are using what? Marginal. So we start with what? Budgeted contribution for the year. So we have two columns here. So we'll be doing some of them and be adding. So let's come here. So we bring our budgeted contribution. Budgeted contribution here. We start with, okay. So this is the reconciliation is very simple, okay. Our profit, if we have prepared our profit statement will be prepared on budgeted items. Now, certain things have now happened during the year. So let's say our budgeted profit was what? Was 50,000, okay. But this was done based on a material cost that is going to be 20,000. Now the material cost that has been incurred over here is 25,000. You can see that our cost has been increased. So this one will now be reduced by what? 5,000. So that's how we do. So for us to get the actual results is just the what? The budget that we have, adjust with anything that has happened during the year. That will give us the actual result, because the actual result will be either the increment to the budget or a reduction to the budget. So that is the idea about a reconciliation. So we have the budget. Now the budget was based on 5,000 units. So the budget was based on 5,000 units. Now we have sold 5,500 units. So it means our our budgeted profit that we have will be increasing by 500. How do we know the differences in the 500? Is by calculating the variances that the 500 will be causing. That's how we go about it. That's how we start. We always start with the budgeted profit, because if you have the budget and we add what happened, the difference relating to the 500, that will now give you the actual result. So we start with the budgeted profit, and we now bring the other variances over there. So we'll bring the budgeted one. Then we now have the sales variances here. The sales variances, since this one we are doing basic, we break it down to the sales price variance. So we break it down to sales price variance, okay, the sales price variance. Then we also break it down to the sales volume contribution variance, not profit. Sales volume contribution variance. We break it down to that one. Then we count to the cost variances over there. The cost variances, you'll be having material, and the material is only one. So we'll be having the material price, and we're having a usage. So let me just write material price variance and material usage. So material price variance. So the material, okay, under the flexible one, we do the total for the material as a whole, but this one we break it. We want to know the source of the problem. Why is the material cost increasing? Is it the amount that we are paying, or it is the usage that is bringing the difference? So what is where the problem is coming from? Is it the price that we are paying, or it is the usage that is causing the difference? So we don't calculate it like how we calculate it for flexible budget, where the variance will be calculated at the total level, where we combine the usage and the price effect. No. For standard costing, we want to trace the problem. Where is the problem coming from? Is it coming from the price that we are paying, or it is coming from the quantity that we are using, so that we can actually work on that? So we have the material price, then we have the labor rate over here, labor rate, then we have the labor efficiency. Sometimes there can be an issue of idle time. So you can check the question to be whether there is an idle time issue there. Okay. Sometimes the amount that you are going to be paying to the people will be different from what the, okay, there's no issue of this one. So 36,000 hours of labor we are paid for at cost of this one. So we assume that that is the one that they have used, and that is the one that they are paying for. Sometimes the hours worked will be different from the hours paid for. It means that they have paid for idle time. So we bring the idle time variance over here. So we also have the variable expenditure, variable overhead expenditure variance. So you bring the variable overhead expenditure, variable overhead expenditure variance. Then we look at the variable overhead volume or efficiency variance, any of them. So we now count to 4. Since this is what marginal costing, we only calculate fixed overhead expenditure variance. Fixed overhead expenditure variance. But if it should be absorption costing, it means that the part of the cost will be consumed into the production cost. Part of the cost will be consumed into the production cost. So we look at the volume also. But this one, the fixed cost will be treated as a period cost. So we calculate only fixed overhead expenditure variance. Okay, so let's go and pick the question now. Calculate our budgeted what? Our budgeted profit for the year, and we see what we can do. Budgeted contribution. We start with budgeted contribution. Let me see what I've written there. Budgeted contribution or budgeted profit. Okay. Charles, are they asking us to reconcile budgeted profit or budgeted contribution?
Budgeted profits.
Okay, budgeted profit. So we have to start with budgeted profit. But how do we calculate the budgeted profit? That should not be a problem. Okay. So we start budgeted what? profit. But that will not be a problem. I will tell you how we calculate the budgeted profit. Okay, so let's go to our workings now. We have the workings one. Okay, workings one, we have our workings one. We have budgeted profit. Profit is calculated as contribution minus the fixed cost, isn't it?
Yes, sir.
Okay, so let's calculate our contribution. The contribution should be the budgeted contribution, which you also call the standard contribution. What would be the standard contribution?
So 500 minus the summation of the three material, labor, and variable overheads.
Okay, so we have the budgeted contribution. So let's have our selling price. All of this one will be per unit. So we do the selling price per unit and subtract our total variable cost. So selling price is 500, isn't it?
Yes, sir.
Our direct material cost per unit is what?
200.
200. So our labor is what?
120.
Labor
Variable
cost.
overheads is 90.
So variable overhead is
90.
what? 90. So the contribution will give us 90. Is that correct?
Yes, sir.
Okay.
Yeah.
So contribution is 90 multiplied by the budgeted output. Budgeted output. That will give us the budgeted output there.
He said, and budgeted production and sales were 13,000 units.
So the budgeted output or sales is 13,000, isn't it?
Yes, sir.
So what will be our total contribution?
$1,700,000. Sorry, 1,170,000.
Yeah.
Okay. So we are keeping 3 zeros. 1170.
Okay, so 1170, yes.
Okay. So let me do 3 zeros at the top here. So we have 1170. What will be our fixed cost? Budgeted fixed
Budgeted
cost.
fixed costs were 600,000. So 600.
Okay. So the difference will give you what?
570.
570.
Okay, 570. So this is how we calculate our budgeted what? This one. So we have this one. I don't know whether the ratios will be this one. So let me just do the 570,000 over here by taking the 3 zeros at the top. I don't know whether all of them will be in zeros. So that is it for that one. So let's now start with our sales variances now. So we come to workings 2, the sales price variance. What is the changes in the sales price variance? So the sales price variance is the amount that we are receiving from the sale of the item. Okay. So let's come to, so Charles, how much are we receiving for one quantity based on our standard?
We are receiving 500.
500.
So how many quantity has been sold?
11,000.
The actual quantity that has been sold is what?
Were 11,000.
Okay. The actual quantity that has been sold is 11,000. So we are having 500 multiplied by 11,000. This should be the price that we should receive from the sale, isn't it?
Yes, sir.
But how much has been received?
5720.
57.
We are holding 3 zeros.
So
57.
let's just leave it. Okay,
Okay,
if
so
we are writing that, so 57 20,000.
20. Yeah.
Okay. So how much supposed to be received from the sale? If we are selling at 500 and we have sold 11,000, how much should have been received from the what? From the sale based on our standard?
5,500,000.
So we have 5 this one like this minus what? 57. Okay. So what is happening here? Are we receiving excess or we are receiving less than our budget?
Receiving in excess.
By how much?
220,000.
220,000. Okay.
220,000.
1,000. That will be favorable, isn't it?
Yes, favorable.
So you come here and have your sales price variance over here to be 220. You net the two and send the answer there. So we come to the sales volume. The sales volume talk about the effect on our contribution. Our contribution was calculated based on what? Was calculated based on 13,000.
13,000.
Okay. But what is the quantity that has been sold now?
11,000.
11,000.
It means that we have overestimated our contribution, isn't it? The contribution included in the
By
budgeted profit has
2,000.
been overestimated. So by 2,000. So we now have the 13,000 minus what? The 11,000
11,000.
multiplied by the budgeted contribution or the standard contribution per unit. That will give us 90, isn't it?
96.
Yeah, 90.
So that will give us 2,000 multiplied by 90.
180,000.
180,000 what?
Adverse.
Adverse. So this one is just talking about the impact on our what? On our contribution. We have overestimated our contribution by 2,000 units, and contribution per unit is 90. So we have to go and remove that from this one over here. So you can be adding favorable or adverse, or you can be putting those adverse, you can put them in brackets. Those that are not this one, you can put, so we can add the favorable over here. Then we can come over here, 180,000 adverse, or you can put them in brackets, adverse in brackets, favorable as positive. What will be the net effect of this one?
40,000.
40,000 favorable.
Okay, 40,000 favorable. So you add it to your budgeted one. What are you having there? The budgeted profit. What will be the total budgeted profit now?
610,000.
So 610,000. So that will now give us we have now what? We have now bring our profit to what? We have now bring our budgeted profit to actual level, to actual result based on the what? Based on the 11,000 now. So we have 610,000. Then we look at what is the cost effect on this one. This will be favorable. So the cost effect, we now go to material. So we do material price variance. Okay, material price variance, we do it on the quantity that we are buying. How much did we say that we have to pay for every quantity of material that we are buying?
200.
No, that is the per.
Oh, okay, 40.
We are saying that we are going to be paying 40, isn't it?
Yes, 40.
What is the total quantity that has been purchased?
66,000.
So based on our budget,
66,000.
how much should have been spent for the 66,000 that we are buying?
Okay.
2,640,000.
Okay, but we have paid what? 2,970, isn't it? Okay.
Yeah.
Okay, so we should have paid 40 by what? 66,000, isn't it?
Yes.
But we have paid what? 29.
70,000.
70,000. Okay. So how much should have been paid based on our standard or based on our budget? How much should have been paid, which we call the flexed amount? How much should have been paid? I'm having 2,640,000.
Yes, 2,640,000.
Okay, 2,640,000. But we end up paying 29. Please, the material price is calculated on the material that you have purchased, not the material that you have used. Okay, you have purchased 66,000, you have paid this amount. How much should have been what? How much should have been paid for that one based on your standard? We do it for what? For the actual quantity purchased, not used. That is what the question is telling you, that the entity used standard costing. Unless the question is telling you that the entity used actual quantity, where you now have to find the cost that you should have paid for the actual quantity that you have used, and the cost that has been paid for the actual quantity that has been used. So we do this one for what? For the quantity purchased, not the one that you have used. If you have purchased 5,000 and you have used 4,000, you didn't pay for 4,000, you paid for 5,000. So the amount that you have paid, how much should have been paid based on your standard or based on the amount that you have budgeted? That's what we do. We don't do it for actual quantity used. Okay, let's come to this one. What is the variance here?
330,000.
330,000. Adverse or favorable?
Yes.
Adverse.
Okay, let me establish this thing. Okay, don't go there and be doing standard price minus actual price multiplied by actual quantity purchase. No. If you do your standard price, this is what you have been doing. Okay, if you do your formula like this, you'll be having standard price minus the actual price. Then you have 40. Okay, then multiply by the actual quantity. How are you going to be calculating the actual price? It's not that the actual amount paid divided by the actual quantity purchased.
Yes.
What are you going to be getting?
So it will be
45.
It will be 40.
Yeah, 45.
Okay, this 45. Okay, then you now multiply by 66,000, isn't it?
yes.
You can see that this answer will still give you what you have divided first to get the answer, isn't it?
Yes.
So just
Yes.
ignore that particular side. Just find this will be 6,000. This will be 40 multiplied by 66,000 minus what? 66,000 multiplied by
Minus
40,
45.
45, which is the same as the actual amount given to you. Whatever you have done, you will still be getting the actual figure. So ignore that actual rate, unless the question is giving you the actual rate, that you have to now go with this one. But you calculating the actual rate yourself, please save that time for what? Something else. Just bring the total amount. Sometimes to you calculate the actual rate, it will not give you a whole number. It will be give you a recurring one. How do you approximate? They have given you the figure to be this one. You are now approximating to get a different figure. How? So just find the amount that you should have paid based on your budget, based on the quantity that you are buying. You are saying that you are going to be paying 40 per every kilogram. You have purchased 66,000 kilograms. How much should have been paid for that based on your budget? And how much has been paid? What should be the flex amount? The first one is based on 13,000. So we now flex it to 11,000. And what is the actual result? We compare. That is all. Very simple. So don't go and be there and be doing standard price minus the actual price. You are going to be wasting time to calculate that particular one to get an answer that has been given to you already. So just ignore that one and find that particular one. So we are having 330 adverse, isn't it?
Yes, sir.
So 330 adverse. Okay. So let's come to material usage. Okay. What is the quantity that has been used to produce the actual results?
63,000.
Okay, 63,000, isn't it?
Yes.
How many quantity do we say that we are going to be using per unit based on our standard, based on our budget? How many quantity are we saying that we are going to be using per unit?
5 kilograms.
Okay, so if we are using 5 kilograms to produce 1 unit and we have now produced 11,000, how many quantities should have been used to produce the actual result, which is 11,000?
55,000.
Okay, 55,000. And we ended up using what?
63,000.
63,000.
Okay, so it means that we have overused, or we have used
More than
8,000 in excess, isn't it?
Yes,
Yes, sir.
$8,000.
So that 8,000 will be valued at what? The standard cost of what? 40, isn't it?
46.
Okay. So this is calculated like this. Your standard quantity will be based on your standard. What is the requirement per unit? You are using 5 kilograms per unit. So every unit that you are producing is 5 kilograms. At the end of the day, you have produced 11,000. Based on your budget or standard, how many quantities should have been used to produce the 11,000? That would have been 5 multiplied by the 11,000. So let me just write the material usage over here. So I'll have the material usage. Okay, the material usage variance, I'll have material usage variance will give you your standard quantity, which is 5 multiplied by 11,000 minus the actual quantity used, which is 63 multiplied by the standard rate. This is usage. We are not buying. So we said that assuming the price has not changed, what will happen? This will now be 8,000 multiplied by what? 40. What are we having?
Adverse of 32,000.
Adverse of 32,000.
320,000.
320.
300. Yes.
Okay. 320. Okay. Let me demonstrate this one. Then 221. So maybe we can do some small things on this one. But for the variance, we have done so many things in class. Let's come here. Come to this one. Okay, let me demonstrate something over here. Although we have done this before, but I want to show the similarity between the similarity between the flexible budget and this one. Okay, but the flexible budget will not be given out this one. But let's come here. Let's move on. We don't have time. Okay, so we have the adverse of this one to be 320, isn't it?
Yes, sir.
Okay, the net effect will be what? 650 adverse.
Yes,
sir.
Okay, so
Yeah.
the net effect will be 650 adverse. Let's come to labor now. So labor variances. We have the labor rate. Okay, the labor rate, how much has been paid for how many hours?
1,400,000.
1,422,000, isn't it?
we knew. We made it.
I guess 36,000 hours.
Okay, so they have paid 1,422,000 for 36,000 hours, isn't it?
Yes.
But how much are we saying that we have to pay if we don't want to pay? How much are we saying that we are paying for 1 hour?
40.
40, isn't it?
40.
Okay, so based on our standard, how much should have been paid for the hours that has been used?
1440.
That will be 40 multiplied by 36, isn't it?
Yes, sir.
Yes, please.
Okay, and that will give us how much?
1,440,000.
So
1,440,000.
So 40 multiplied by 360 minus what? The total amount that they paid was 1,422,000. How would I solve? Okay.
It's 1,420.
1,440,000.
No, the actual one.
Yeah, it's correct.
I think it's
Correct.
1,420,000.
Is it the same as what I've written over there?
Yes, it's the same.
Yes.
Okay. So let's come to so what should have been the amount that we should have paid? What should have been the flexed amount?
1,440.
Okay.
Yeah.
Minus this one. Are we paying more or we are paying less?
You are
paying less.
By how much?
18,000.
18,000 per. Okay, that will be favorable. So we come here and have labor rate will be 18,000 what? Favorable. Let's come to labor efficiency. The labor efficiency has to do with the number of hours that have been used to do the work. So let's come to the labor efficiency variance over here. So we come to efficiency. Okay, since nothing has been said about the hours worked, it means that we have paid for the one that they have worked, isn't it?
Yes.
Yes,
So
sir.
36,000. So they have used 36,000 to produce how many units? They have used 36,000 to produce how many units?
11,000.
11,000
Okay.
units.
But how many hours are we going to be saying that we are going to be using to produce 1 unit?
3 hours.
What?
That should have been 3 hours, isn't it?
Yes,
Yes.
please.
So if we are sticking to our standard, how many hours should have been used to produce that?
33,000 hours.
So we have 3 multiplied by 11,000 minus what? 36,000. Then this will be valued as
Multiplied
what
by
the standard, which is
46.
40. So it means that we have what? The people are not being efficient. So the production process,
They are not being efficient.
so we have absorbed more of the hours over there, which will give us 3,000 hours. We have used 3,000 in excess at 40. What are we having?
120,000 adverse.
120,000 adverse. So we come here and have 120,000 what? Adverse.
Adverse.
What will be the net effect?
102,000 adverse.
102,000 what?
2,000 adverse.
Adverse. So we come to our variable overhead also. Variable overhead is always valued in relation to what?
Labor efficiency.
Labor efficiency.
Okay, labor hours. Don't go and say efficiency and variable overhead is always paid based on what? Based on the labor hours. Okay.
Okay, sir.
So we have the variable overhead. So it varies in proportion with what? With the labor hours. So we come to the variable overhead expenditure. So we look at the expenditure variance over here. So we have the expenditure variance. The expenditure is the amount that we are paying. How much has been paid for the what? How much has been paid for the variable overhead?
1,170,700.
Okay, this has been paid based on how many labor hours? This is paid for how the labor hours, how the labor hours.
36,000.
It is paid for 36,000, isn't it?
Yes.
Okay. Please,
Yes, sir.
if you are given, I hope you can remember that we say that if you are given, assuming the question has given you the hours worked, is what? Is 33,000, and the hours paid for. We use the hours paid for. We use the amount that we have paid. But if you are coming to the efficiency we use 33,000, which is the hours worked. Then the remaining one will be idle time, isn't it? Okay.
Yes, sir.
Okay.
And if you count to the variable overhead, which of the hours that we use? Do we use the 36,000 or 33,000?
33,000.
33,000. The variable overhead will vary with the what? With the hours used on the what? On the work. But this one is the same as 36,000. So how much do we say that we are going to be paying per hour for the variable overhead?
$30.
Okay, 30 cedis, isn't it?
Yes.
Okay. So how much should have been paid based on our standard or budget?
30.
1,080,000.
1,080,000.
Okay, so that would have been this figure. That would have been 30 multiplied by 36,000 minus what? How much has been paid?
1,700.
700, isn't it?
700. Yes,
Okay.
sir.
So, but the amount that should have been paid should have been how much?
1,080,000.
Okay, 10.
80,000.
Okay. So against this one now, what is happening? Are we paying in excess?
Yes, sir.
Yes, sir.
How much are we paying in excess?
Adverse of 90,700.
Adverse of 9,700. These people, they are not efficient. Why? Plenty what? Or maybe they are setting the standard under normal what? Under absolute what? Working condition. So maybe they are using what we call what? Charles, what is the name of that standard?
The ideal standard.
Okay. They are setting an ideal standard. No allowance for what? For losses. Okay, so we have 9,700 adverse. Let's go to the efficiency now. The efficiency is calculated like how the labor efficiency is calculated. So, okay. So efficiency of volume, you can see efficiency of volume. Okay. So that would be the same as how we calculate the labor. So that would have been 3 hours by so how many hours would have been used against the hours that has been used, multiplied by the standard. The standard is now 30, isn't it? Okay. So that will give us 3,000 hours in excess valued at what? The standard rate. What are we getting?
90,000.
90,000 adverse, isn't it?
Adverse.
90,000 adverse. So we have 90,000 adverse. What would be the what? What would be the 180,700 adverse, isn't it?
Yes.
Okay. So okay, so let's go to, so someone should give me the variance that we are going to be calculating for the fixed overhead. I've said that one already, fixed overhead. Fixed overhead, what will be the variance that we calculate?
Fixed overhead
Expenditure.
Okay, so we only calculate the expenditure because this one, whenever the cost is incurred, we take all of them to what? To profit or loss, isn't it? Okay.
Yes, sir.
So how much are we saying that we are going to be incurring? What is a budgeted fixed overhead?
600,000.
600,000.
So that should be 600,000. But what is the actual amount that has been incurred?
400,000.
400.
400,000.
Okay, so that will be
Favorable of 200.
200, favorable of 200,000. So you go there and do your favorable of 200,000. So you come over here and have favorable of 200,000. So you just put all of them together. Your net, the result will give you the net loss or the net what?
Gain.
Net profit for the what? Or the profit for the year or the loss for the year. Okay. So that is it. Let's recalculate that. So this one, we have calculated the basic variance at the same time the reconciliation. So mostly they can ask you for the reconciliation or they can actually ask you to calculate the basic variance because most of the time this will be for like 10 marks, then they will bring some theory question for 5 marks. So just master the basic variance well, and we see what we can do. Let's recalculate what the fixed production overhead variance, assuming the company uses absorption what? Costing. Okay. So this is what we are going to be using. It doesn't change the fact that we still calculate so the variance will still be the same thing over here. The one that we have calculated will still be the same, isn't it?
Yes, sir.
So, but we add volume what? Variance. Okay. So we are saying that the 600,000 will be based on what? How many units? How many units?
13,000.
13,000, isn't it? Okay.
Yes.
Now what is happening now? We are producing what?
We are producing 11,000.
So you can see that we are going to be having an issue of we know that fixed overhead does not vary with the output level, isn't it?
Yes, sir.
Okay.
Yes.
So we are going to be using 600,000 for 13,000. Now you are using 11,000. Are you losing or you are gaining?
Losing.
Okay. So we look at the loss that you are going to be incurring. So we come over here. This will be budgeted quantity minus the actual quantity multiplied by the standard rate for the what? For the fixed overhead. How do we calculate the standard? The standard rate over here is a total budgeted one, which is what? 600,000 divided by the 13,000. I hope that is correct. So if we want to know how much we are incurring per unit, we are saying that we are going to be using 600,000 to produce 13,000. So how much are we incurring on what? On one unit?
46.15.
Is it absolute or you are approximating?
Approximation.
If it's approximation, just give us, if you are having fraction, give us a fraction.
630.
Is
600 over 13.
okay, 600 over 13. So it means that every unit we are going to be incurring 600 over 13. But what is going to be happening is that we are saying that we are going to be producing 13,000 and we are going to be incurring a cost of what? Okay. We are going to be producing 13,000. At the end of the day, we have produced what? We are going to be producing 11,000 and carrying the same cost. We are losing. So we look at the loss that will come in over there. So we have the 13,000 minus the 11,000. Then you multiply by the 600 over what? Over the 13. What are you having? If you are still having the decimal, then we just write it to the decimal.
You have 92,397.69.
So 92,000.
397.69.
So we
You
have
can do it 92,308.
92, 300 and what?
8 to the nearest whole number.
Oh no, mention the phone, let me see.
397.69.
So it should be
9307.
308. It should be 308, isn't it?
Yeah.
Yes.
308. Okay. 308 what? Adverse, isn't it?
Yes, sir.
Okay, please, the volume, we don't look at it as cost. This cost does not change with the output level. So if you are producing more, it is the same cost that you are going to be incurring. So that will be a gain to you in terms of cost. That will be economies of scale. That's a gain to you. But you are incurring 600,000 on 13,000. Okay. It's a fixed cost. It will not change with the output level. Now you are producing 11,000. It means that all things being equal, you are going to be getting a particular cost over there. So this one, we are just looking at the issue of the under absorption and over absorption. That's how we do if you are doing the total what? Fixed overhead, under absorption or the over absorption in terms of what? In terms of the fixed overhead. So just we have done the basic one and then the fixed one. Discuss possible causes for the labor variances you have calculated. What do you think will be the cause for labor variances calculated? Are they all adverse? The labor variances, are they all adverse?
No, sir.
Are they all adverse? Let's check. Labor. The rate
The
is
price was favorable. The efficiency was
okay.
adverse.
The rate was favorable, isn't it?
Yes, sir.
Okay. But this thing is what? The
The
efficiency.
efficiency was adverse.
Okay. We call something interdependence of what? Of variances, of interrelationship between variances. Okay, come here. Why do you think the labor rate is what? Why do you think the labor rate is favorable? Look at the material. You can say the material both are what?
Adverse.
Both are adverse.
Okay.
Yes.
The material price being adverse can be that we are buying higher quality material, isn't it?
Yes.
Okay. If we are buying higher quality material, are we going to be using more labor hours to what? To produce them? It means that there will not be any material loss in the process, which we have to start with the process again because the material are of higher quality. So the labor, the hours that we are going to be using will not be that much. Okay, will not be that much as compared to if the materials are fake. If the materials are fake, you can see that in the production there will be some material because there can be also poor handling of the material. Then there will be an issue. We have to go and repurchase the material and bring them again. Okay, so the labor rate over here is because the company is employing what? A cheaper grade of labor. That is the problem. Why? Look at this one. You can actually say, they say possible. Okay, you can actually say the general ones, but I want you to know how to link the variances between themselves. We call something interrelationship or interdependence of what? Of variances. What do we mean by that? An adverse performance in a particular variance will automatically lead to what? An adverse performance in the other one. Okay, let's come to this particular issue over here. Material price. The material price over here can mean that what? We are buying what? Higher quality of material. It can also mean that we are buying a fake material and the labor that we are also employing is also not skilled. Okay, they are cheaper and there are going to be a lot of what? Mishandling of material. So a lot of material are going to be getting spoiled during the production process and we have to replace them. So we are buying more material than we should buy. And that is why we are incurring material costs. As far as you are employing cheaper labor, it means that your labor rate, you are going to be paying them what? A low rate. Okay, employ somebody who is a chartered accountant and someone who is an SHS labor. Which of these people are you going to be paying more?
The CA.
Okay. But you will see that you are going to be using, the CA will be using lesser period to do some work, isn't it? But the person who is an SHS labor will be taking more time to what? To do the work. And that will be leading to inefficiency of that particular person. And that will be leading to a labor efficiency what? Variance of being adverse. So this one can mean that the entity is employing what? The entity is employing what? A cheaper kind or caliber of labor. The person is employing a cheaper caliber of labor, or the entity has been able to negotiate what? The wage rates, or maybe the government has now established a wage rate that is below. So there can be a lot of issues. Okay, you can just talk about the possible causes because the question is not giving us enough information about that. Okay, but the most possible cause is what? The entity is using a cheaper what? Caliber of labor, and that is what the efficiency. If the caliber of the people are very cheap, it means that they are going to be spending more time on the work. They are going to be spending more time on the work. That is why we are having what? We are having this figure as what? As the efficiency over there. Okay. That is why we are having this particular figure over here. The labor efficiency, since we are having a what? A low caliber of workers, they are going to be spending more time to carry out simple instructions. So that's also the reason over here. Or there have been a breakdown in machine, or there have been a breakdown in the machine hours, and we have used more hours as unexpected. That is the possible causes. You can talk about other issues, but there can be a lot of issues that you can think about. Okay, there can be a lot of issues that you are, or maybe they are even, if it is a low caliber of people, it means that people will now be saying that, okay, now you are paying me 50 pesos per 1 hour. So that what I have to do is that I have to delay on the work. So that is what the electrician, most of the people that provide services, that's what they do. You see, the electrician will come to your house. He can spend 1 minute to dictate the fault and correct it. But because if he spent 1 minute to do the work, you will say that the work is not anything. So you are going to be giving him something small. So what he will do is that he will go somewhere, scatter some things, come to this place, scatter the other ones. Then he will come, then he fix them. Then he will come to the major problem, the problem that he can even spend like 2 minutes to do it. So that you look at, okay, this person, he has tried, he has spent like 1 hour to do this, so he has done a lot of work, and you now give him something better. Okay, that's what those people they can do. Because if they want to, you are paying me a cheaper amount of money. If I want to speed up with the work, the amount of money that I'll be getting at the end of the day will not be higher as compared to if I should delay with the work. Okay, so that can also be the low caliber, or maybe, yes, so a lot of things can lead to the inefficiency, but the problem is going to be the low caliber of workers, the low caliber of workers. If you're having people who are not skilled, who don't have the expertise, your wage will be very low, but what the number of hours that you are going to be using to do one simple task is going to be more than anyone who is very skilled and expert in that particular field. So you can talk about any other issues, but that is what I want to actually tell you. Or you can also say that there is a lot of mishandling in the production process that is leading to restarting the process. So because the material are fake, we start producing, and the production process have to restart again, and people have to work at different hours again also. But if you have a quality material, there is no way, even if the mishandling is like that, the production process, the time that is going to be taken will not be that much as compared to a fake material. Okay, as compared to a fake material. So you can actually talk about those issues, then you can see what you can do. Let's now calculate the capacity one here. Again, let me calculate the efficiency and capacity. Then we can now call it a day for today. Okay, actually we have done something. At least you can revise something also on your own. So let's see. Just take the issue of the question 5 there. Let's see if we can tackle that one. But you have to still revise the material mix and material yield. For the material price and those material usage is the same thing, but the material mix. So you have to, the actual quantity I have to use, if you want to mix it based on the actual if we want to mix that particular one based on our standard usage, how would have been the mixture? Okay, we have done that. So you have to actually revise that again and take it and use it to solve that question. Okay, just take the question number 5 for us and let's see.
Okay, so question number 5.
Yeah.
Ghana National Gas Company is a gas processing company, and it has its plants located in Atuabo in Western Region. The plant produces 3 gas products: lean gas, liquefied gas, and natural gas condensate. The standard time for the production of the 3 products are 40 minutes per metric ton for LG, 30 minutes per metric ton for LPG, and 45 minutes for NGC. The budget for the month of February is as follows: 45,000 metric tons for LG, 25,000 for LPG, and 30,000 for NGC. And the actual data for the month were as follows: labor hours was 70,000 hours. Production was 48,000 metric tons for LG, 27,000 for LPG, and 25,000 for NGC. Required: compute the following: A, the efficiency ratio; B, the capacity ratio; and C, the production volume or activity ratio.
All right, Charles, how do you calculate efficiency ratio?
So we have the budgeted hours over the actual hours times 100.
Budgeted what?
Budgeted hours.
Standard hours, Father.
Standard hours over actual hours.
Standard hours over what?
Actual hours.
Okay. So the efficiency is calculated like how we calculate normal efficiency for labor. So that is going to be the what? The standard hours money. So we just what we so we just change that one to be a fraction. So let's come here. Our efficiency ratio is calculated as the standard hours over actual hours multiplied by 100, isn't it? All right. The question, in most cases, the question will always give you the information on the, or they will give you the actual hours, but you have to calculate your standard hours. We know that standard hours is just the what? The budgeted hours multiplied by the actual quantity, isn't it? The standard hours or standard hour per unit. So let's calculate the standard hours. Please, we do this on total basis. So you do the hours for each of them and put them together. So we know the standard is calculated as our standard multiplied by the actual result in total. So let's come here. Standard time for the production of products are what? LG. How many minutes are we using to produce metric ton?
40 minutes.
Okay, you can see that the actual labor hours is the actual labor is given in hours, isn't it? So you also have to calculate the standard also in hours, not in minutes. So you change the hours to
Yes, sir.
change the minute to hours. So we have the LG. So what will be the standard hours for the LG? That will be 40 over 60 multiplied by the actual quantity that has been produced. That's how you calculate the standard. So what are we having there? LG.
48,000.
Okay, so we have 48,000 metric tons. So 48,000 metric tons. How many hours are we going to be using? So LPG will be 30 minutes. So LPG will be 30 over 60 multiplied by how many units have been produced?
27,000.
Okay,
27,000.
27,000 metric tons.
The first one's
But
flexed
let's write all of them before.
32,000.
Let's write all of them before. So this will be 45 minutes against what? 25,000, isn't it? So what is the name of the last one?
NGC.
NGC.
Okay, so we have the NGC to be 45 over 60 multiplied by the quantity produced.
25,000.
2070.
Okay. So what will be the answer for this one?
18750. NGC.
NGC, okay.
Yeah.
180. Okay. Would this be
First one is 32,000.
Would this be 13,500?
Yes, sir.
Yeah.
And this is 32,000.
1,000.
Okay. The total will give us what?
64250.
64.
250.
Okay. Okay, so we have so this will be 64250 divided by the actual hours is what?
70,000.
17,000 multiplied by 100. What is the answer?
97.979.
97,
91.79.
91.79. Okay, 91.79.
Yes.
Okay, So if they want you to comment on this answer, what are you going to be saying? What are you going to be saying about this one? Let me calculate the second one before we come to the, let me calculate all of them. Capacity, how do you calculate capacity?
Actual hours over budgeted hours times 100.
Capacity, hey, madam, it seems like you have this thing in your head. Okay, that is fine. Okay, so actual hours over what?
Budgeted hours times
Okay.
100.
So for me, I don't have this one. I don't have, because these formulas are not what they are not derived by any of my family people. So I cannot keep them in my head. Okay. So this is what I do. I know that for efficiency, the efficiency is calculated as what? Standard hours. Efficiency, I just want to know whether the people are being efficient. What do you mean by efficient? What should be the hours that should have been used to do the work based on my standard? And how many hours has been used? So if they are doing the work in a lesser hours than I'm budgeting, then it means that they are very efficient. But if they are doing more than what I'm doing, so what I will do is that what is the actual hours used to do the production, and what is the hours that I'm saying I have to use to do the work. So I'm using 3 hours per unit. So I've produced 3,000 and I've used 10,000. I should have used 9,000. It means I've used 1,000 hours in excess to do the work than the standard. So I know that that's how I calculate it. But I know that if you come to one of them, which is a production or activity ratio. Okay, the production activity ratio, it is the efficiency ratio multiplied by the capacity ratio. Okay, it is the efficiency ratio multiplied by the capacity ratio. The answer that I'm going to be getting will be a standard hours over the budgeted hours. So what I'll do is, if the first one is standard hours over actual hours, okay, I know that at the end of the day, the actual hours will be canceling if I multiply by this one. So what do I have to do over here to cancel the actual hours so that I'll have standard hours in relation with what? With budgeted hours now. So what I'll do over here is that I have to have actual hours over here over the budgeted hours. You can see that this and this will cancel. So this is how I try to remember the capacity ratio, because capacity, the production is the efficiency multiplied by the capacity ratio. So how do I do? I have this one now. What do I do? How do I write this one in terms of budgeted hours so that my actual hours will cancel? I have to do something like this. So for me, I normally remember that one to be the actual hours over the budgeted hours multiplied by the 100. Okay.
Okay.
Okay, so let's come here. Actual hours and budgeted hours. Okay, so we now calculate our budgeted hours. So we now calculate our budgeted hours over here. So budgeted hours, they'll give you information on the budgeted hours. Okay, they will give you information on the budgeted hours. Charles, you can see the budget for the period is what?
The budgeted hours.
Now the budgeted quantity is over here, isn't it?
Yes, sir.
Okay, the standard hour per unit is the same as the budgeted hour per unit. Are you okay? So if you reduce your budget to a unit level, that is now a standard. But if you cross your standard to a total level, that is a budget. So standard is measured at the unit level. That's why I'm saying that for standard, we try to break down the material variance to price and usage to know where the problem is coming from. But if it should be a budget, we just gross the two and say that, okay, we are having this in terms of the budget. So we have to go material is what increasing. So let's address that particular one. So if we come to the budgeted hours over here, you have your LG should be the same thing as the 40 over 60, but multiplied by the budgeted quantities. That's what we do. So we have the LPG, okay, which is 30 over 60 multiplied by the budgeted one. Then we have 45, which is the NGPC. NGC will give us 45 over 60 multiplied by this one. So let's go there and look at our budgeted output. Budgeted output is
45,000.
For the first one.
25,000.
So we have 45, 25, and we have what?
30,000.
30,000. So this will be 12,500. Last one will give us what?
22,500. The last one.
22,500.
And 30,000.
And 30,000. The total will give us what?
65,000.
65,000. Okay, so that will give us, this will give us, the actual is what, 70, isn't it?
70, yes.
Okay, 70 over 65,000 multiplied by 100. What are we having?
107.69.
107.
0.69.
0.69%. Okay, so I've given you a clue on the calculation of the production or the activity. Please, let's try that and give me the answer. Then we come to the interpretation now. To the production. Because if they want to ask you this one, they will always ask you to interpret your answer. Because the production, what are you getting? Production, they can call it production or
Please, can I see the efficiency ratio?
production or the activity. So if they ask you activity, it shouldn't be there and be saying that you haven't seen it before.
I'm having 98.85%.
Can someone confirm that?
Okay.
Yes.
Okay.
Okay, so let's come to the interpretation now. Let's come to the efficiency one. Okay. What is the standard hours? The standard hours. Okay. If you subtract from this one.
Difference is 5750.
5750. So you can see that we are using 5750 more hours to achieve the what? The actual production than the what? Than the standard hours, isn't it?
Yes, sir.
Okay, so you can also use the difference over here to explain, or you can use the difference over here. Okay, so we are just, this one, the ratio we are just trying to see, okay, what percentage, okay, what percentage of the what? Of the production that is relating to the standard hours. Okay, so if we are using this particular standard hours, it means that we are going to be producing only 91%, 91.79% of the actual production. So if you want to get the actual production, it means that you have to spend 57250 hours. So 57250, 5750, okay, 5750 hours has been used in excess of the standard hours to achieve the what? To achieve the actual production. Someone can also say that the people, the workers are not efficient, or the entity is not efficient. So they have used 5750 hours in excess to produce the actual result, which is a difference over here. Okay, so what it means also means is that more of the what? Or you can find a difference. What is the difference in terms of percentage? the total production should be 100%. So what is the difference there?
8.21.
8.21, isn't it?
Yes, sir.
Okay, so it means that
Yes, sir.
8.21 of 8.21 more hours has been used to produce the actual result as compared to the standard. What it means that you are using more hours to produce what has been produced than what? Based on your standard, you should have been using 64,250. You have used 70,000. So you have used more hours of that particular difference to produce the actual result. That is what we mean by what? We mean by the efficiency. Okay, let's come to the capacity ratio. The capacity, we are talking about what? We are talking about we having a budget of 65,000. By the end of the day, we have used what? We have used 70,000, isn't it?
Yes, sir.
So we should have used 65,000. The maximum that we have to have is 65,000. Okay, we should use 65,000 to achieve whatever we want to achieve. We have used 70,000. It means that the production that we are going to be getting will be higher than our budgeted production, isn't it?
Yes, sir.
Okay, this doesn't mean that the entity is using more hours. Our maximum, the quantity that we want to use, the budgeted, the capacity that we want to use is 65,000 to produce our budgeted result or to produce the actual result. But we have now used 70,000. It means that our actual production will actually be higher than our budgeted output. Okay, that is the meaning of okay. So that is the meaning of that. Or you can also see the actual hours that has been used is something. What is the difference there? The difference between the hours
5,000.
is 5,000, isn't it?
Yes, sir.
Okay, so you can also say that 5,000 hours has been used in excess to produce the actual result. Anyhow, just look for the difference and it's not a difficult thing to actually interpret it. You can just use the difference between them and say what you are seeing over here. Actual is 7,000, budgeted is what? Is 65,000. So it means that we have used 5,000 hours in excess to get whatever we are getting. That is very simple. You don't have to do anything about that particular one. So you just look at what you have used and just use the hours, the difference, to say whatever you want to see. Okay, it's not anything that you have to go and look for the interpretation anywhere to come and do. Okay, just so that is all for that one. Please, any question? If there are no questions, then tomorrow will be the last day where we are going to be looking at the the management accounting in the public sector, and also the short-term decision making. But the short-term decision making, we are going to be looking at relevant costing, make relevant costing or some part of make or buy, and the limiting factor. So we can also look at one question on the this one. What do they call it? Cost, volume, profit analysis. Or we can also look at how to set a pricing, the pricing technique. So I can bring you a question where the pricing techniques and other ones will be there. Okay, will be there. So if there are no issue, thank you for coming, and I will see you guys tomorrow. All right.
Thank you, sir.
All right.